Good afternoon, dear students, and thanks a lot for the Teachers' Day wishes. I could see that being posted in the earlier link that you have provided, earlier link that we had provided, and due to some issue, I could not continue it there. So now we'll continue in this new link. Till the time new users join in, let us wait for a couple of minutes, and then we'll be able to start this off, right? So yeah, that stream ended because there was some issue and it got interrupted abruptly. So that's why I had to create a new stream immediately, and hence we moved everyone here. We'll wait for a couple of minutes till the time students join in. And then yes, I think students have started joining in. Thank you, Gopal. Thanks, Radhika. And thanks everyone who had wished me in the earlier stream as well. Okay, now the overall context of this, the next 3 hours that we will be spending together. Thank you, Radhika. The next 3 hours that we will be spending together, we will be focusing on the accounting standards of Group 1, which account for about 25 to 30 marks in every attempt. At the end of this session, you will be confident enough to handle multiple different types of questions in the examination, especially from accounting standards. Thanks a lot, Yashwant. I think yes, users have joined in. These notes you can, I'll pin the description link in the description. Now, what I wanted to show you overall here is this aspect. 28 to 28 marks about on an average, that is what comes from accounting standards, and we'll be covering all of these accounting standards, AS1 till AS16 today. We'll be revising in these 3 hours so that you have absolute confidence for the examination. That is the whole purpose of this live session. Any question you have, you can let me know. We will also be taking up some specific questions from the past examination papers, which will help you understand the aspects related to accounting standards, how they are tested, right? So some of the compilation and past accounting questions, we will be covering that as well, right? So I hope all of you are excited for the next 3 hours, and we'll make it fruitful for each one of you. Even if you are for the first time, we will ensure that we cover maximum extent possible from an examination point of view. Thanks Zitu, thanks Sudarshan, thanks Saran, thanks a lot for your warm wishes. It actually makes us feel humble that we have been able to contribute in some form or the other to the student community. So to begin with, we start with accounting standard 1, We start with accounting standard 1, one of the most simple accounting standard, I say, right? As far as accounting standard is concerned, what does the accounting standard want us to do? Accounting standard wants us to disclose significant accounting policies that the enterprise has adopted. That is the first thing. So you have to disclose the significant accounting policies, and if there are any changes in accounting policies, that has to be disclosed. Now, why do we change accounting policies? Changes in accounting policies are done, number 1, for better presentation, or if it is required by any other AS, or if it is required by any statute, right? So you should disclose significant accounting policies and changes in accounting policies so that users know what is the accounting policy adopted by an enterprise while accounting for different transactions. Now question comes, what is accounting policy? And this is covered in detail by AS5, but just to give you a brief, if you talk about inventory, we can follow FIFO method, we can follow weighted average method. What is our policy of accounting for inventory? Or for property, plant and equipment, we can follow cost model, we can follow revaluation model. So which model are we following? That is a matter of accounting policy, right? So that policy has to be disclosed, and changes in accounting policy has to be disclosed. Now AS1 also talks about certain fundamental accounting assumptions, which is going concern, consistency and accrual. So 3 fundamental accounting assumptions that is followed: going concern, consistency and accrual. Now what is the meaning of going concern? Going concern means that an enterprise, see, these are the keywords, okay? Because it is a revision, I am not going to too much of depth of each aspect of the topic. Whatever I am highlighting, that is very, very important for you when you are answering theory questions in the examination. So what is going concern? The going concern is an assumption that an enterprise will continue its operation in the foreseeable future and neither has the intention nor a necessity. So first, enterprise will continue its operations in the foreseeable future. It doesn't have any intention nor there any need or necessity of what? Of liquidation or curtailing materially the scale of its operation. So there is no need. Means what? Enterprise will continue to operate in the foreseeable future, a period of 12 months and beyond, and there is neither any need nor there any necessity to either liquidate, means close down, or materially curtail the scale of its operation. So this is the going concern assumption, the first fundamental accounting assumption. All the financial statements are prepared using this assumption. If financial statements do not follow this assumption of going concern, then you have to disclose that fundamental accounting assumption has not been followed. Now what happens is, if going concern is followed, for example, if there is a car, this car is worth 5 lakh in the books. We show car as property, plant and equipment at 5 lakh in the books. But if there is no going concern, if going concern assumption is invalidated, then what happens? Then in that case, you will value this car at the realizable value. Realizable value may be 4 lakhs. So you will value the car at 4 lakhs only. So that is the impact of going concern assumption. That is the first aspect. Then the second aspect is consistency. Now what is consistency? Consistency means you will ensure that there is consistency in using the accounting policy. It is not that 1 year I will follow one method or one policy, next year I will follow another method. That is not permitted. You must be consistent. Consistency means, for example, we have been valuing, let us say, property, plant and equipment using the cost model. Consistently follow cost model. It is not that 1 year I want cost model, next year I want revaluation model. That switching should not happen frequently. Now, whenever there is a change in accounting policy, for example, last year we followed one accounting policy, this year we want a second accounting policy. If there is a change in accounting policy, then what must be disclosed? We must disclose the change and the monetary effect of the change on the financial statement. Means, what is the change? We change the valuation method for inventory from FIFO method to weighted average method. So what is the change? What is the monetary impact? Because we change from FIFO method to weighted average method, we have a monetary impact of, let us say, profit is overstated by 1 lakh or profit is understated by 1 lakh. That has to be disclosed. Now when can we change an accounting policy? If it is required by a law, if it is required by an accounting standard, or for better presentation. So this is important. You must explain when or why an accounting policy can be changed. That is the first thing. If it is changed, you have to disclose the change and the impact of the change in the financial statement. Monetary impact. If monetary impact cannot be quantified, you have to mention that, okay, we cannot quantify the monetary impact. Then accrual basis of accounting. Now this we have been following since the time we started learning accounting. Cash basis and accrual basis. Under accrual basis of accounting, you will recognize the transaction or you will recognize income and expense as and when an enterprise earns the income or enterprise incurs the expenditure. So when we say accrual basis of accounting, transactions are recognized as soon as they occur, whether cash is actually received or paid. So in cash basis of accounting, I will account for a transaction when I make a payment of cash or when I receive cash. In accrual basis of accounting, I will not account for transactions on cash basis. I will account for the income when I have earned the income. I will account for the expense when the expense has been incurred, irrespective of whether cash has been paid or not. Right? So that is the accrual basis. So three fundamental accounting assumption: going concern, consistency, accrual. If it is followed, no separate disclosure is required. If it is not followed, you have to make a separate disclosure saying that this has not been followed. Okay. Now, what are accounting policies? Accounting policies are specific accounting principles and the methods of applying those principles. So there is a principle and method of applying that principle. So there is a principle, method of applying that principle, that is called accounting policy. For example, inventory, FIFO method, weighted average method, that is a method of choice of accounting policy. Depreciation, the way you calculate the depreciation, SLM, reducing balance method, unit of production method, that is a policy choice. But one thing you have to keep in mind, change in this method is considered to be a change in estimate. So it is both an accounting policy question as well as estimate related question. Okay, valuation of investment, fixed assets, government grants, right? All of these are your accounting policy choices. Now, whenever you choose an accounting policy, you choose an accounting policy so that there is a true and fair view. Okay, that's all you need to understand here. Then there are three considerations that AS1 says that you have to consider while choosing an accounting policy: prudence, substance over form, materiality. Sir, what is prudence? Prudence means I will recognize all anticipated losses. I will recognize all anticipated losses. I will not recognize any anticipated gain. So all probable losses are provided for. That is called the concept of prudence. That is why when you learn, for example, accounting standard on construction contracts and all of that, any foreseeable loss is accounted for. That is the concept of prudence. Then substance over form. We need to account for transaction considering the substance of the transaction rather than the legal form. For example, you will learn in accounting standard 19 a concept called leases. Now in case of leases means what? We have taken something on rent. We have taken something on rent. Now when you have taken something on rent, we should actually account for rent expense. But AS19 provides some situations where even if you have taken something on rent, you will recognize an asset and a liability. Why? Because the substance of the transaction says that it is not a rental transaction, it is a purchase transaction. So you will choose prudence, you will choose substance over form and materiality. Always remember, though we talk about tallying the balance sheet, 5 rupee difference, 10 rupee difference and all of that, in real life materiality as a concept is what works. So if for example you talk about Reliance having turnovers of lakhs of crores, for them, items of 100, 200, 500, purchase of a mobile phone of 2000, 3000, that may not be material. So that they may have an accounting policy where they say, we purchase mobile phone below 5000, we will expense it. Sir, but we'll get future economic benefits? Yes, we'll get future economic benefits. But 5000 in a business of lakhs of crores is not material. So don't break your head in calculating depreciation of that mobile phone, this and all of that. So you use materiality as a concept to choose the accounting policy. So three consideration: prudence, substance over form and materiality. So in real life you will realize that everything you will not work out to in minutest detail possible. You will also see how much of cost is being incurred, how much of amount of effort is being involved to compute or to calculate that specific item. So prudence, substance over form and materiality. These three are the considerations that you must take when you choose accounting policy. If you want to remember, you can just use this MSP. That will help you to remember. MSP, minimum support price, materiality, substance over form and prudence. Right. So that is the consideration for choosing accounting policy. Then AS1 requires, because the standard is based on disclosure of accounting policies, you must disclose in the financial statements the significant accounting policy adopted in the preparation and presentation of financial statements, and you should disclose it as a part of the financial statement itself, and any change that has a material effect in the current period or is reasonably expected to have a material effect in the later period should be disclosed. So you have to disclose in the current period as well as in the subsequent period you need to disclose. So that is all as far as AS1 is concerned from the point of view of your examination. So this question continuously comes up a lot of time in the examination also. ABC Limited was making a provision for non-moving inventories based on the issues for the last 12 months up to 31st March of year 16. The company wants to provide during the year ended 31st March based on technical evaluation. So what are they saying? Earlier we were doing based on non-moving inventory. Non-moving inventory means inventory which is not being sold. Inventory which is not being sold. Now they are providing based on inventory which is not being sold, they are providing or they are making a provision. Okay. Now what they want to change? They want to change it to a technical evaluation. Means we'll get some expert to provide for non-moving inventories. Right. Now the value of inventory 100 lakhs, provision required 3.5, new provision required 2.5. Does this amount to change in accounting policy? Can the company change the method of provision? Now What are we changing? We are changing the way we estimate the provision. Here we are changing the way in which we are estimating the provision, but we are not changing the accounting policy. See, our policy was what? To provide for non-moving inventories. Earlier we used to provide based on 12 months issue. Now we are providing based on technical evaluation. So considering both of these, there is an inventory provision that we are making, that is an accounting policy, but the method of calculation, that is not a change in accounting policy. So here how do you answer is define accounting policy. Accounting policies are the specific principle, basis, conventions, practices applied by an entity in preparing and presenting the financial statement. Or you can also use the definition that we have understood earlier, specific principles and method of applying those principles. Method of estimating the amount of provision may be changed. However, this is not a change in the accounting policy, but it is a change in the accounting estimate, right? Now that is what has to be done. So it will not constitute a change in accounting policy. What kind of disclosures are required? If it is material, you will have to make the disclosure saying that earlier it was 3.5 lakhs, now it is 2.5 lakhs, and this kind of disclosure has to be given. So the total value of inventory, the change in amount of required provision of non-moving inventories is from 3.5 lakhs to 2.5 lakhs. If it is not material, then you are not required to make any disclosures. If it is material, then you can make a disclosure like this, that okay, if the same method was followed in the previous year, the profit and the net assets would have been lower by 1 lakh, right? So you have to decide, is it material or non-material, and accordingly you will have to make the changes or make the disclosure. Moving on to the next standard. Normally every alternate attempt we see a question from accounting standard 2, inventory. Very important from the examination point of view as well. In case you have any questions while I am discussing, or you want me to solve some specific question, please feel free to ask that. Okay, now accounting standard 2 on inventory. Now what does accounting standard 2 deal with? Inventory. Inventory is nothing but your stock, what you see as opening stock and closing stock, right? Now inventories are assets which are held for sale in the ordinary course of business. This is your finished goods. So for example, I am a computer dealer, I have computers in my shop, that computer is my inventory. So if it is held for sale in the ordinary course of business, that is called your finished goods. Second, in the process of production of such sale, work in process, I got raw material, the raw material is in the process, that is also my inventory. And in the form of materials or supplies to be consumed in production process or supply of services, that is the raw material. So basically inventories are raw material, work in process and finished goods. Sometimes questions asked in the examination, they ask you to compute the value of inventory. When they say value of inventory, don't only compute FG or WIP, you have to calculate all of these in totality. Highly scoring, you must be able to make 5 out of 5 in this question as far as AS2 is concerned, right? Now, the golden rule of valuation of inventory is inventories are measured at lower of cost and net realizable value. Always remember, inventories are measured at lower of cost or net realizable value. What is net realizable value? Net realizable value is the estimated selling price in the ordinary course of business less estimated cost of completion and cost necessary to make the sale. For example, estimated selling price is 1000. Commission, I need to pay 2%. Cost to complete, let us say, is 100. So NRV will be 1000 minus 2% of 1000, 20, minus cost of completion 100. So it will be 880. This is the NRV. Let us say cost is 700. So cost or NRV, whichever is lower, 700 is lower, so you will value it at 700 only. So this rule you should not forget. There is one exception in case of raw material, which we will be talking about when we reach the raw material valuation part. Right? Now, what is cost? As far as cost is concerned, cost includes the cost of purchase, the amount you pay to the supplier, plus any import duties and other taxes which are non-refundable. What is an example of refundable tax? What is an example of refundable tax? If there is any refundable tax, you will not include it here. Then transport, other cost, anything, each and every item or each and every item of cost that is incurred to bring the inventory to the location and the condition that I want or that the entity wants, that is included in the cost of purchase. That is included in the cost of purchase, right? Now, if there are refundable taxes, for example, GST, refund is not physical refund only. Refund also means if you get input tax credit. So if you get input tax credit, that will also not be included in the cost of purchase. Always remember, if it is taxes, it should be non-refundable. If you get input credit, if you get refund, that will not be included, right? Then any discounts or any other rebates you receive, you will remove. Only trade discount, cash discount is not removed. So this is the cost of purchase. Cost of conversion. Cost of conversion means this is more in case of work in process and finished goods. So cost of conversion is your labor, other direct cost, any direct material you take, any overhead, fixed as well as variable. All of this is included in the cost of conversion. Okay. Direct material means any material which is added as a part of the process. Otherwise, this material here comes in the included here. So you will not do double counting of the same thing. And any other cost to bring the inventories to their present condition and location, that should also be included in the cost of inventory. So this is not Ind AS 23, this is AS 16. Okay. So cost of purchase means purchase price plus all taxes plus cost of conversion means all labor, other direct cost, fixed overhead, all of that will give you the cost of the inventory. This cost you will compare with the net realizable value. Whichever is lower, that will be the valuation of inventory. Right. Now moving on to overhead. So let me do one thing. Let me create one more. Coming to overhead related discussion. This is for AS2. Okay. Now as far as overhead is concerned, a lot of times students get confused as to how should we calculate and when should we calculate revised overhead. So the simple way to remember is, let us say fixed overhead budgeted is 1 lakh, units budgeted is, let us say, 10,000. So we determine something called as overhead recovery rate, which is 1 lakh divided by 10,000, which is 10 per unit. So you will take, let us say, direct material 100, direct labor 50, fixed overhead, you will take this 10 per unit and you will add it. You will take this 10 per unit and you will add it. So 100, 50 and 10, 160. You will always take predetermined overhead. But if actual production is greater than budgeted production, for example, actual production is 15,000, budgeted was 10,000. In this scenario, you will calculate something called as revised overhead recovery rate. What is that? 15,000 units and 1 lakh is the cost. So 15,6, so it is 6.66. Always, whenever the actual output is greater than the estimated output, in that case you will calculate revised overhead recovery rate. So what you need to understand here is, if the actual production is less than or equal to planned production, then you will use the predetermined overhead recovery rate. But if it is greater than the planned or normal production, you will recompute the overhead recovery rate and you will add it to the cost of inventory. So while calculating in the examination, what you have to do is, cost of inventory will be, if you are doing on a per unit basis, you will take direct material, direct labor, variable overhead, fixed overhead, all of these put together will be your cost. That cost you will compare with the net realizable value. Whichever is lower, you will consider for inventory valuation. Right? Then NRV is based on future selling price. NRV is based on future selling price or the selling price estimated on the date of the balance sheet. So normally what we do is on 31st March, what is the estimated selling price? Sir, we don't have the estimated selling price on 31st March. Then sometimes you can take future events if it is held under a firm contract to sell. Firm contract to sell means I have entered into a contract and I must compulsorily sell that inventory under that contract. Then the contract price can be considered to be the NRV. Okay. Now, if future price reductions happen, that should not impact my NRV calculation because it is on 31st of March. What is the rate on that date? That is what I should consider. Okay. Sometimes events occurring after the balance sheet date, you will consider only if they provide additional evidence of events existing on the balance sheet date. This you will understand more on accounting standard 4. So no need to worry about here. Okay. So whatever is the most reliable evidence available as on the balance sheet date, based on that you will calculate the estimated selling price, and based on that you will calculate the net realizable value. And whenever you are comparing inventory, let us say we have 3 inventories, ABC, 100 is the cost, 110 is the NRV, 80 is the cost, 60 is the NRV, 20 is the cost, 30 is the NRV. Now you cannot say my total cost 100, 180, 20, 200, 110, 60, 30, 190. So I'll take 190. This is not allowed. What you have to do is 100 and 110 lower, take 100, take 60, take 20. So 100 plus 60 plus 20, 180 should be the value of your inventory. You have to do it on an item by item basis. You should not do it on a global basis. Okay, so let me see. Do we need to remember which A's are applicable to firms at different levels and whether particular A's is fully or partially applicable? I do not suggest students to remember that thing by heart. If you can see, only thing what you can do is some specific A's which are not applicable. For example, let's say AS3 is not applicable to some specific entities. Those you can make a note of it. Those you can make a note of it. Other than that, you don't need to bother about what is applicable, what is not applicable. In my video towards the end on applicability of accounting standards, I anyways have given a summary, a run through summary. Read it once. So the thing is, the way I look at examination is it worth the time and effort that I put for my preparation? For example, if I have to spend multiple times, 7 hours, 10 hours to remember all of those things, is it worth that 3 to 4 marks that comes in the examination? So what I suggest is, fully which is not applicable to some specific entities, you can just make a glance through of that and that is enough. Otherwise, applicability, non-applicability would not, I would not want you to bother much on that aspect. Okay. Now, so far what we have done, we have calculated or we have understood that inventories are always measured at lower of cost and NRV. There is an exception for raw materials. We'll come to it subsequently. How to calculate cost and how to calculate NRV is what we have covered, right? Then, whenever there are joint products and byproducts, joint products are important products, byproducts are, scrap products kind of a thing. For example, if you process, crude, you get petrol, diesel, gas and all of that. These are joint products, and byproducts are scrap or something like that, right? Now, how do we allocate? So when we say joint products and byproducts, what happens is, just a moment. If there is a joint product, so let us say there is common cost of 1000. Okay, common cost of 1000 means, let us say there is this crude oil. This crude oil has a cost of 1000, with which I have produced petrol, diesel and LPG gas, for example. How do I allocate this 1000 amongst these 3 products? That is what the standard says. So what the standard says is, so these are costs, common cost. You run it through a process, and from a particular point you get 3 products. This is called split of point. This is called split of point. So all the cost incurred till split of point should be allocated between these 3 products. The best way to do that is NRV at split of point, or estimated selling price at split of point. So what you have to do is, you have to calculate estimated selling price at the split of point. If that is available, use that. So this is the first preference. If that is not available, calculate the NRV. So how do we calculate the NRV? Again, estimated selling price minus the cost of completion will give you the NRV, right? So Joint costs which are incurred are allocated on the basis of relative sales value or NRV at the split off point. Now, for example, you can look at this example. Questions have been tested on this, and again, it's highly scoring. Okay. In the course of the class, if you have any questions, any doubt, feel free to add. Any interest or other borrowing cost to include or not to include? If it is borrowing cost, if it is a qualifying asset as per accounting standard 16, you should include. But at a CA inter level and also at a CA final level, in fact, for that matter, I don't expect such kind of advanced questions being tested. And even if they test that question, they will mention that this is a qualifying asset as per accounting standard 16. Okay, so let's look at this question. During the production of main product Bomex, a byproduct Brusil is also produced. Total cost of conversion is 3,88,500. 12,500 units of Bomex and 7,000 units of Brusil arise from the process. Brusil cannot be sold at the time of split off. Brusil cannot be sold at the time of split off, and it can be sold after processing. Cost of further processing. I think there is some mistake here. Byproduct can be sold at 6. Calculate the cost of conversion of Bromex, which is the main product. So, cost of further processing is 0.5. Okay, cost of further processing is 0.5. So, Brusil you cannot sell at split off point. So, what will you calculate? You will calculate the NRV. So, how do we calculate the NRV? Estimated selling price minus processing cost. What is the estimated selling price? Estimated selling price is 6. Processing cost is 5. 5.5 is the NRV at the split off point, right? Now, this NRV at the split off point is for which product? It is for the product Brusil, which is a byproduct. Now, here please remember this example that I gave you, allocation of joint cost, that is for main products, that is called joint product. If it is a byproduct, like scrap, if it is byproduct which is scrap, what we do is either we take it as other income or we reduce from cost. So here 38,500 is the NRV of byproduct, not BB, not blood pressure. Okay, NRV of byproduct. This NRV of byproduct, first choice is I can take it to other income. Second choice is I can reduce it from the cost of main product or cost of the production. So we can subtract this from the cost of main product, which is 3,88,500 minus 38,500, which is 3,50,000. So 3,50,000 becomes the cost of Bomex. So cost of Bomex simply calculated as total cost minus cost of the byproduct, 350 divided by 125, I get 2.8 per unit. Okay. Now, these are some cost formulas which are generally not tested in the examination. I have not seen much of these being tested in the examination. More they focused on applying the principle of cost and NRV only. Okay. Now, what are the various valuation method? Cost formula means if I have to determine cost of inventories, what are the various formulas I can use? Now, if inventories are not ordinarily interchangeable means, let us say there is a product, there is a furniture, customized furniture, which cannot be ordinarily interchanged. In such cases, you will use specific cost. You will use specific cost for the product. For example, I manufacture or I have an order of 5 types of furniture or 5 furniture orders. Each furniture is a different one. I cannot interchange. If I cannot interchange, what I will do is for each furniture, I will check what is my cost and I will accordingly calculate the cost of the inventory. If they are ordinarily interchangeable, remaining all categories, your FMCG products, cement, then steel, okay, oil, all of that which are ordinarily interchangeable, you will use either FIFO or weighted average if you are using the historical cost, or you will use standard cost and retail method. Now, normally, you will use this category, FIFO and weighted average. Now, what is FIFO and weighted average? FIFO means first in, first out. These are called cost flow assumptions. What does that cost flow assumption say? FIFO means whatever comes in first will be sold first. Whatever comes in first will be sold first. Whatever comes in last will be sold last. That is the FIFO assumption. Now under FIFO assumption, what you do is, let us say on 1st of January of 23, you have got 100 units at 10. So this is 1000. On 15th of January of 23, you got 50 units at, let us say, 12, which is 600. When you sell on, let us say, 17th of January, you sold 80 units. You will assume that you have sold from these 100 units. So the inventory will be 100 minus 80, 20 at 10, which is 200, and 50 at 12, which is 600. 800 becomes the inventory. That is called FIFO method. The other one is called the weighted average method. So what is the weighted average method? Weighted average method basically say you have 150 units which cost you 1600. So 1600 divided by 150, the rate becomes 10.66. This is the cost per unit, which is 10.66. So my inventory of 70, I will multiply by 10.66 and get the cost of inventory. That is called the weighted average method, right? So you can have the FIFO method or weighted average method. Sometimes if it is not materially differing from your actual cost of inventory, you can use standard cost. I know a lot of you would be scared of this chapter in cost accounting, correct? How many of you are scared of standard costing in cost accounting? Either you can use standard cost or you can use the retail method. Retail method is more like my sales price minus the gross profit percentage will give me the cost. So if you look at large departmental stores and all, they will say, okay, the total selling price of all the inventory is 1 lakh. Profit margin is 20,000. So the cost should be 80,000, because small items, biscuit items, chocolates and all of that, if you start doing one by one valuation, it becomes really difficult. But all of this in computerized environment becomes very easy. So even in a large departmental store, you can actually apply FIFO or weighted average as per the choice of the company. Most of the times what we see, companies apply weighted average to determine the cost of inventory. One more thing, LIFO is allowed or not allowed? Is LIFO method allowed or not allowed? LIFO method is not allowed in the as per accounting standard 2. Even as per India Institute is not allowed. LIFO is allowed as per US GAAP. US GAAP allows LIFO method. That is one aspect, right? So this is how we use various cost formula. Very rarely we get questions from this aspect, but still, if at all we get questions, we should be able to handle that, right? Now, raw material valuation. This is where I was coming to. Very important. Very important. We'll solve one question on this also. Raw material valuation. Raw material is generally valued at cost. Raw material is generally valued at cost. We don't put this called lower of cost and NRV, because realizable value can be of finished goods, because we sell finished goods. Raw material will not have realizable value because we don't sell finished goods, we don't sell raw material. So raw material is valued at cost. But if finished goods selling price is less than cost, and there is also a decline in raw material prices, then we will value them at replacement cost. Don't take this formula. A lot of students, I've seen a lot of questions from students saying that, sir, can we say it is lower of cost and replacement value? No, you cannot say that. You can say that only when selling price is less than cost. Only when selling price is less than cost, only then you can apply this concept. Otherwise, it has to be valued at cost only. Some smart students, extra smart students, I will say, what they say is, sir, selling price is less than cost. Let us say selling price is 100, cost is 120, it is less than cost. Replacement cost of the raw material is 50, cost of the raw material is 40. Then we should value it at 50. No. You cannot value it over cost or above cost. I've got at least 7 or 8 questions on this line, okay? So, don't think that if this condition is satisfied, it has to be replacement cost. That is not the right approach. If this condition is satisfied, Then if the value of the material has fallen below cost, then you will say I will value it at replacement cost. So replacement cost is higher than cost, then value at cost only. You will never value inventory at above cost, unless of course advanced scenarios when you have hedging and futures and commodities and all of that you will understand at final level. No need to worry right now. Okay, any questions, please ask, otherwise we will continue. Okay, no questions. This is very important question, has been tested time and again. So please ensure you practice this question. Market is important as well. Okay, here in the manufacturing process of Vijay Limited, one byproduct BP emerges besides two main products MP1 and MP2 apart from scrap. Details of cost of production process are given below. Raw material for 15,000 units 1,60,000, wages 82,000, fixed overheads 58,000, variable overheads 40,000. MP1 we produce 6250, MP2 5,000, BP 1600, byproduct, closing stock 800 and 200. Average market price of MP1 and MP2 is 80 per unit and 50 per unit respectively. So this is 80 and this is 50. Byproduct is sold at 25. There is a profit of 5,000 on sale of byproduct after incurring separate processing charge of 4,000 and packaging charge of 6,000. Rupees 6,000 is realized from sale of scrap. Okay. Calculate the value of closing stock MP1, MP2 as on 31st March of 12. So this is a very old question and has been coming up again and again. Now, what you need to understand is, if so, there is this byproduct, there is this scrap. So sometimes if cost is not given, then replacement value will be used. Yes, but in most of the cases you will have the cost as well. I will not, if you have a question from the exams, I have rarely seen such questions. Cost will be given. It is not that cost will not be given. Okay. Now, here this BP1 is a byproduct. You have, other than that, you have scrap also. Sometimes students get confused. This BP is also this scrap. No, that is not there, right? So you have total cost of material, wages, fixed overhead, variable overhead. All of these costs have been incurred. This total, from this total cost, what we will do is we will reduce the NRV of byproduct and scrap. NRV of byproduct and scrap. What is the NRV of byproduct? 25. NRV of byproduct is 25 and production unit is 16,000. Production unit is 16,000. So raw material cost 1,60,000, wages, overhead, variable overhead. This is the total joint cost. From this, you will reduce the NRV of the byproduct. What is the NRV of the byproduct? Total selling price 25 into 16,000. 25 into 16,000 is 40,000 minus processing charge of 4,000 and packing charge of 6,000. Okay, so processing charge of 4,000, packing charge of 6,000. This is one, and sale of scrap 6,000. So you have 3,04,000. Right now, how do we allocate this 3,04,000? This 3,04,000 should be allocated between MP1 and MP2 on the basis of estimated selling price at split of point. Estimated selling price at split of point. Now don't do this mistake in the examination that you will allocate both of them at your 80 and 50. No, you have to calculate the total estimated selling price. Total estimated selling price. Now what is the total estimated selling price? 6250 into 80, 5,000 into 50. So this is the total estimated selling price. This total estimated selling price, you will split 3,04,000 into 5 lakh and 250, total is 750. So into 500 divided by 750 and 250 divided by 750, this will be the cost of each product or cost of each material. Now this cost you will compare with the selling price. So selling price, anyway they are saying higher, 80 and 50, both of them are higher. So you will value them at cost, which is 25,944 and 4,054, right? This anyways I was going to cover, Ashwin, you anyways put it out. Here is where I will talk about the replacement cost. Okay. Now, A Limited is engaged in manufacturing of chemical Y for which raw material X is required. The company provides you with the following information for the year ended 31st of March. Cost price 380, freight inward 40. 40 will we include or not include in the cost of inventory? Freight inward of 40 will we include or not include in the cost of inventory? Come on, we will include. So this will be included. So raw material will be 380 plus 40, 420. And let me tell you, this is one question where I've seen students in the examination making maximum mistakes in inventory question. We find it to be so simple, so logical, but still, because of some fear factor, because of some lack of clarity, unable to read the question, we make mistakes in the exams. And sometimes these questions are lengthy also, right? So 380 plus 40, 420. This is the cost of X. Y. 440 plus 120. Material consumed and labor. 440 plus 120 is for this. As you also have unloading charges 20. So that also needs to be added. Variable overhead also needs to be added. So we use raw material X to manufacture chemical Y. We use raw material X to manufacture chemical Y. So you have raw material cost price, freight and unloading charges. I missed that. So plus 20 you have to do. Then chemical Y, material consumed 440. How did we get this 420? 440. 420 plus 20 is equal to 440. So 440 plus 120 plus 18. Right. Now, sorry. Total fixed overhead for the year was 4 lakh on normal capacity of 20,000. So 4 lakh on normal capacity of 20,000. So divide by 20,000. You'll get the rate. Closing balance of raw material X was 1000 units, chemical Y was 2400 units. You are calculate the total value of closing stock of raw material and Y according to AS2 when NRV is 800, NRV is 600. Right. Now, first thing, we have to calculate chemical Y cost. Chemical Y's cost is how much? 440 plus 120 plus 80 plus 20. 20 of fixed overhead. 440, 120, 80 plus 20, 660 is the cost. This is a straightforward thing. 660 is the cost. Then cost per unit of raw material X 440 we have already calculated. Now what do we need to do? If it is 800, what should be the cost? 660, 800. Whichever is lower, you will take 660. So in the first scenario, you have 660. In this case, raw material will be valued at 440 only. Why? Because finished goods is being sold at greater than cost. Second scenario, 600. 600. If it is 600 per unit, which is less than 660, what does that mean? NRV is less than cost of finished goods, so you will value it at 600 only. Then in that case, at what rate will you value the raw material? Raw material, if now here you have to make an assumption that it is being sold at below cost and they have also given us replacement cost of 300, means raw material prices are declining. Raw material prices are declining. Finished goods is sold at lower than cost. Finished goods is sold at lower than cost. In that case, your valuation will be 1000 into 300. This is the replacement cost. As I told you, you have to calculate the total value of inventory. This comes from 5 marks. It's a long question, I know. You know, if you see the working, it's a very, very long question, but you'll be easily able to score 1 mark here, 1 mark here, 1.5 mark here, and 1.5 mark here. 5 out of 5 question is this. Right. Now, I'll bring a twist here. If the replacement cost is 400 or 500, let's say. Replacement cost, if it is 500, then here you will not use 500. You will not use 500. No, you will use cost only. Always remember, it cannot be above cost. Whatever is the finished good selling price, it cannot be above cost. Is that clear? Any questions? Please feel free to ask. So these two questions, illustration number 13 and this, time and again they have been tested in the examination. So ensure that you will have a look at it before the examination as well. So to summarize, inventory, lower of cost and net realizable value. Raw material always at cost. If finished goods are sold at below cost, raw material will be lower of cost or replacement value. Okay. Then, if you have joint products, you will allocate the joint cost based on estimated realizable value or estimated selling price or at the split of point. Fixed overhead, you will allocate using the predetermined overhead recovery rate. But if if the actual output is more, then you will account or you will recalculate the overhead recovery rate. Are we clear? Okay. Now moving on to the cash flow statement. So this you can have a look at it, the exemptions and all of that. Now when it comes to cash flow statements, this PDF is for the paid students. I'll still see if we can put it down in the app. I'll upload it and I'll put it as a description and you can download it. Right. Now coming to cash flow statements, accounting standard 3. As far as cash flow statements are concerned, AS3 talks about we preparing cash flow statements. Two methods are given, direct and indirect. And so we have cash flow statement accounting standard 3 where we classify cash flows. Cash flows basically means what you have paid, what you have received, the cash inflows and cash outflows. You bucket them as operating activities, investing activities and financing activities. Operating plus or minus investing plus or minus financing activity will give you the net cash generated. This you will reconcile with opening cash and closing cash. So basically, if you look at a cash book, opening cash flow plus whatever are the cash inflows minus whatever are the cash outflows, that will give me the closing cash flow or closing cash balance. That reconciliation is covered as a part of accounting standard 3 cash flow statement. It's under the accounting standard 3 cash flow statement in these 3 categories. Now, important part is cash and cash equivalent. Now, what is cash and cash equivalent? Basically, money that I have with me, cash in hand, money that is lying with the bank, cash at bank, then cash in hand, cash at bank, then demand deposits with any bank. Demand deposits means the deposit which I can withdraw on demand. It is different from the fixed deposit. Demand deposit means I want the money. I'll go to the bank and say I need my money back. That is called a demand deposit. So demand deposit is also cash equivalent. And term deposit is not cash and cash equivalent. So cash and cash equivalent, when we talk about, we have cash in hand, cash at bank, demand deposits and cash equivalents, which are, now cash equivalents means these are not cash, but these are like cash. These are not cash, but these are like cash. So what is the meaning of like cash? Like cash means I can easily convert them into known amount of cash without any risk of loss in value. For example, I have a 2-month FD. 2-month FD and the rate of interest is, let us say, 5%. I can withdraw that 2-month FD, or I can, I'll get 2 months cash after 2 months without much loss in the value. So cash equivalents are short-term, highly liquid investment that are readily convertible into known amount of cash and subject to insignificant risk of change in value. That is why a short-term investment which is due within 3 months, that are considered to be your cash equivalents. Means when we say cash equivalent, whatever amount I'll receive, that I should know there is no risk in that particular amount. Now, if I have investment in shares, that will not be considered to be cash equivalent. So why is that not considered to be a cash equivalent? Because investment in shares, I don't know the amount. Investment in shares that I don't know the amount, that will not be considered to be cash equivalent unless it is something like a preference shares maturing within 2 to 3 months, within 3 months of time. Okay, but generally investment in shares are not normally taken as cash equivalents, right? So cash in hand, bank, demand deposit, and cash equivalent, which are short term highly liquid investment less than 3 months, readily convertible into cash. I can convert that into cash, and which are subject to insignificant risk of change in value, right? So that is what is called the cash and cash equivalent. Now the format, if you see, you will have operating cash flow, investing cash flow, financing cash flow. This will give you the change in cash and cash equivalent. You will have opening and then you will have closing. This is the indirect method of preparation of cash flow statement, right? Now how do we classify? So for that, I'll prepare a simple structure for you to remember. How do we classify the cash flow statements? How do we classify the items in the cash flow statement? So if you take the balance sheet and if you take the P&L, you have the balance sheet and you have the P&L. Now in the balance sheet you have equity, you have loan, and let us say you have trade payable. You have fixed asset, you have current asset, you have cash. In the P&L you have sales, you have expenses, you have depreciation, you have other income, and then you have net profit. Now in the three categories, operating, investing, and financing, the way you should remember, 99% of the case you can apply this logic and you will get the correct answer. 99% of the case you can apply this logic and you will get the correct answer. Now if it is something to do with the sales, my operations, expenses, which are my operations. Operations means my day-to-day activity of producing goods, supplying goods, paying my employees and all of that. These come under operating activities. These fall under operating activities. And any item to do with these, for example trade payable, or say for example sundry debtors, that will also fall under operating activity. That is why change in your working capital adjustments you show under operating cash flow. Okay, then if it is something to do with acquisition of a fixed asset, acquisition of a fixed asset means I have acquired a fixed asset or I have made certain investment where I am investing money, these cash flows are called investing cash flows. And any income related to this, I have made investment, from that investment I got other income, that also becomes my investing activity. Then if I have raised money, if I want to raise money by equity or loan, I have issued shares or I have taken loan, these are my financing activity. Financing activity means how did I get money or how am I raising money for my business, that is classified as financing activity. This table summarizes how do you classify in operating, investing and financing activities. Now sir, income tax, what do we do? If income tax is related to, let us say, my operations, operating activity, investment, investing activity, as simple as that. Sir, we paid dividend to equity shareholders, financing activity. Sir, there is an interest expense here on loan. Loan is under which activity? Financing activity. So this also goes under financing activity. This interest also comes under financing activity. Sir, I collected some interest from my customer. Then customer is where? Under sales or here. So that comes under operating activity. Sir, what about depreciation? Depreciation, we don't pay any cash. When we don't pay any cash, this does not impact my cash flow. Sir, I sold fixed asset. Sale of fixed asset, it comes under investing activity. Okay. So this is how we classify it. This is how we bucket operating, investing and financing activity. Now other way to understand this is, if investing activity means any addition to fixed asset or deletion from fixed asset, any addition to investment or any sale of investment, that comes under investing activity. Financing activity means if I have raised money or repaid money, something to do with the equity and debt, rest all activities I can bucket them under operating activities. Are we clear with this classification? Any doubt here? Because in examination sometimes you get questions which says interest income, which category? Follow this framework. Anything to do with this investment activity, Anything to do with equity and debt, financing activity, related activity is also classified accordingly, and balance everything you will put under operating activity, right? So that is how we classify. Now let us quickly have a look at the definitions. Operating activities are principal revenue producing activities of the enterprise, sale, activities related to sale, production, operations, and all of that. So operating activities, and if any other activities cannot be classified under investing or financing activities, you will club them under operating activities. Now operating activities, cash sales, cash from fees, commissions, collection from debtors, purchases, and other than that are considered to be cash outflows. So these are the operating activities. Now cash flow from operating activity can be prepared using two methods: direct method, indirect method. Direct method, indirect method. Now direct method is the simplest one. Interest from bank. Now interest from savings bank, normally you will put it under operating activity because balance in the bank is not for investment. Balance in the bank is not investment. Now donation, grant received. Now there are two ways to look at this. If a grant received is against a specific asset, you can bucket them under investment activity. If grant received is in the nature of promoter's contribution, then you can bucket them under financing activity. So there are two views there. So you can use it under investing or financing activity depending on the assumptions that is being made. Okay. So if for example I have received grant against a purchase of an asset, then I would very well classify that under investment activity. There are different views. Even IFRS committees and all have given different views on this particular aspect, right? So that can be followed and you can classify them accordingly. Now when we follow a direct method, it is nothing but just visualize, take a cash flow, cash book, and using the cash book, what you do, summarize all the receipts, summarize all the payments related to operating activities. That becomes a direct method. So direct method is nothing but a summarized form of the cash flow statement, cash book I would say, all receipts, all payments summarized, you will have the cash flow from operating activities. If this comes in the examination, it is super bonus question for you if they ask you direct method. Okay, direct you have to take the amount and you have to calculate. Now sometimes what happens is there are missing information. Now how do we derive the missing information? For example, trade receivable information is missing or sale information is missing. How do we derive that number? So sometimes what happens is, what the questions do, they have this like, okay, opening balance of customers 10,000, closing balance 12,000, amount received we do not know, sales 2 lakhs. Such kind of information may be given. Simply prepare a ledger. Any working for the cash flow statement, best way to understand that is by preparation of a ledger. There is a detailed video on how to calculate ledgers and all of that in the indirect method also in our channel. That link you can have a look at it. You can just search for AS3 Indigolearn. You will get a link for that where I have explained in much more detail as to how to calculate. Right. So you'll prepare a debtors account, opening balance 10,000, closing balance 12,000. Don't write debit this side and credit that side. Sales 2 lakhs. So 2 lakhs plus 10,000, 2 lakh 10,000 minus 12,000, 1 lakh 98,000. So 1 lakh 98,000 is the amount collected. 1 lakh 98,000 is the amount collected. This is the cash flow from debtor for direct method. So if there are any missing information, my suggestion to you would be to please prepare a ledger account, a T-shaped ledger account format that will help you to calculate any missing information, purchase, sale, customers, creditors, debtors, everything you can calculate using this information, right? So you will take cash received from sale of goods, receivables and all of that, and payments. You will get cash flow from operating activities. Now the challenge is for a lot of us under indirect method. Challenge is for a lot of us under the indirect method. So what do we do in case of an indirect method? For indirect method, it is a framework that you need to follow. How do we start? I will not be having a time for getting to the logics, but what you need to do is you need to look at this P&L. You have sales. Let us say you have gain on sale of fixed asset, you have purchases, you have expenses, you have depreciation, you have interest income on, let us say, investment, and you have net profit, and let's say also have income tax, and then you have net profit. Right, now under the indirect method we always begin from net profit. Then what do we do? Is whatever items do not belong to operating activities, gain on sale of fixed asset, you remove it out. Okay, you remove it out. For example, this is 100, this is 1000. 1000 is the net profit, includes this gain. That gain does not belong to operating profit. If the gain does not belong to operating profit, you will exclude that and you will say 1000 minus 100, 900. Then depreciation. Depreciation is a non-cash expense. This also you will exclude. Now depreciation, let us say, is 50. You have reduced 50 to arrive at 1000. Now you will add that 50 back. Interest on income, investment income. This also is not a part of operating activity. You will exclude this. So like this, what you will do is, you will take the net profit, remove all non-cash items, remove all other items which do not belong to the operating cash flow category. Then whatever we are left with are related to your operating activities. But there is one more challenge. These purchases, these sales, all of these are on accrual basis. Means we would have paid cash, we would not have paid cash. How do we handle that? That we handle by something called as working capital changes. Now the simple way to remember this working capital change is, for assets, you simply do opening minus closing. What does this mean? Opening minus closing, if you do, for example, 10,000 minus 12,000, if you do, you will have to do minus 2,000. Means it is an outflow. Indirectly we are saying it is an outflow. But sir, how does it match? See, sales, if we have 2 lakhs, we have taken the sales of 2 lakhs in the net profit. Sales, whatever 2 lakhs is there, we have included that sales in net profit. I have to eliminate the impact of accrual accounting. This 2 lakhs I have not collected. Then so what did I say? Do opening minus closing, I got 2,000 negative. So we will do 2 lakhs minus 2,000, 1,98,000 is the number. This 1,98,000 is the same number that we got here also. So simple way to remember working capital changes. For those of you who forget, keep on forgetting this in the examination, opening minus closing. What you can do, and you can calculate anything related to working capital changes. So then what about liabilities? If asset is opening minus closing, liability will be closing minus opening. Very simple, right? So under the indirect method, you will start from net profit for the year, add back provision for tax if tax is deducted. So always remember, tax we show separately as payment of tax here. So you will adjust this. If there are extraordinary items, you will adjust this, because again you will do the adjustment for extraordinary items here. So add provision for tax, extraordinary items. Then if there are any non-cash items, that also you will adjust. And so non-cash you will adjust. And working capital changes. Current assets, if it is increase means what? Opening minus closing. Simply do opening minus closing. If it is positive, add back. If it is negative, you reduce it. Then determine payment of tax and calculate the net cash flow from operating activities with separate disclosures of extraordinary items. Now here 2-3 things. Sir, why are we doing this opening minus closing? Sometimes what happens is, the question or the question in the examination that does not give us the net profit for the year. They will say opening reserves and surplus 10,000, closing 12,000. So what we can interpret is 10,000 to 12,000, 2,000 is the profit earned during the year. Sir, if you have paid dividend, so the best way to calculate those numbers is prepare a reserves and surplus account. Opening balance 10,000, closing balance 12,000, then paid dividend during the year, let us say 2000. So to bank 2000. So by profit 12 plus 2 14 minus 10 4000. A simple preparation of this account will help you calculate the profit or loss made during the year. A lot of students, when they try to make it in a statement format, you get confused. No need to get confused. You can directly take the ledger format and calculate the profit for the period. That is why you are doing this closing minus opening. If no adjustments are given, directly you can do closing minus opening. If adjustments are given, prepare a ledger and solve the question, right? Then this gives me the cash flow from operating activities. Also taxation paid. Another question where a lot of students have doubt. Taxation paid, how do we do it? So say for example, 2023, 24 and 2022, 24, 23. Advance tax 10,000, 12,000. Provision for tax 8,000, 9,000. Okay, this information is given. Advance tax, provision for tax, this information is given. How do we calculate what is the amount of taxation paid? How is the amount of taxation paid? So what I suggest is prepare a combined tax account. So advance tax to balance, because it's a debit balance, 10,000. Provision for tax by balance 8,000. Then this is the closing balance 12,000. Not contacted. Closing balance 12,000. To balance 9,000. And assume for a moment that this 9,000 is also debited to P&L. So in the P&L the charge is by P&L 9,000, which means 12 plus 9 21, 21 plus 8 29, 29 minus 19 if you see, to bank 10,000. So this is what has been paid during the period. So you can prepare a combined advance tax plus provision for tax account and do the entry. Now the other way to do this is opening advance tax is 10,000, provision for tax is 8,000 for example. So if you net it off, you have 2,000. Net it off, you have 2,000. This 2,000 became 12,000, which means 10,000 we have paid. So where did we get this 9,000 from? This 9,000 is anyways an expense. Okay, so you can prepare a combined account of advance tax and provision for taxation, and whatever is the balancing figure can be determined to be the taxation paid or taxes paid. Otherwise, if for example you are not comfortable with this kind of working, opening if you see on a net basis there is a 2,000 debit. Closing if you see on a net basis there is a, so opening there is a net debit of 2,000, closing there is a net debit of 3,000, and in the period you have charged expense of 9,000. So 2 plus 9,000 minus 3,000 to get 10,000, right? So this is how you can calculate taxes paid during the period. In most of the cases in the examination, advance tax for the period would be the taxes paid during the period. Advance taxes in the balance sheet, advance taxes in the balance sheet will be the taxes paid during the period. Otherwise, you can prepare a combined account and do the working, right? So that takes care of our indirect method. Please remember, the indirect method is applicable only for operating activities. For financing and investing activities, we have direct method only. For financing and investing activities, we have direct method only. Now, what are investing activities? These are cash flows generated from investing activities which are related to acquisition and disposal of long-term assets and other investments. Fixed assets and other investments. These come under investment activity. Anything related to this, interest income earned, your taxes related to this, all of these are a part of your investment activities. Right? Now here, one important thing, if there is gain on sale of fixed asset, In operating activity, when you do the adjustment, here you will do the adjustment for gain amount. But when you capture the same thing for the cash flow purpose, you will take the gross amount. For example, sold for 10,000, gain of 2,000. For investment activity, the cash inflow will be 10,000. For investment activity, cash flow will be 10,000. Okay. So you will take any activities related to cash inflows, cash outflows related to investing or acquisition of fixed asset. Then financing are activities that result in the size and composition of the enterprises, owner's capital, equity, borrowings, debt, own funds and loan funds. When these change, these are a part of your financing activities. So you have cash inflows, cash outflows, for example, issue of shares, loans, increase in bank overdraft, cash credit, payment if you buy back equity, redemption, repayment of loan, dividend and interest. All of these are cash outflows which are considered to be financing activities. Now, you cannot net off receipts and payments from investing activities unless there are exceptions, which are first, cash receipts and payment on behalf of customers. For example, it's a bank. A bank every day, these days you do 10 rupees, 15 rupees of UPI transactions. If they start aggregating and reporting everything on a gross basis, it becomes very difficult. So there, if they are collecting that on behalf of the customers or which are large items, all of these cases you can do it on a net basis itself, right? So placement and withdrawal deposits on a net basis, acceptance and repayment of fixed deposits can be done on a net basis, loans given and advances given and repayments can be done on a net basis. These are the exceptions. Now, if you have given loan and made interest, if it is a financial enterprise, then it is ordinary course of business and hence it will be an operating activity. Now, if you have given advance to employees and interest, then this becomes operating activities. If you have made payment to suppliers and earn interest, this also is an operating cash flows, right? Other things we have already discussed. Dividend tax, dividend paid, financing cash outflow for all enterprise. Income tax for operating income, operating cash flow. For investing, tax deducted at source for investment income, investing cash flow. And if it is interest paid and if that is related to your TDS deducted as a part of your interest paid, that comes as a part of financing cash flow. Anyway, you will report, for example, 100 is interest paid and 10 is TDS. This entire 100 is your cash outflow from financing activities. If there are extraordinary cash flows, that has to be presented separately, that we already know. And this table simply summarizes the various activities of, for financial enterprise, interest received, paid and dividend received, operating activities, dividend paid, financing activities. For other enterprises, interest received and dividend received, investing, and interest paid, dividend paid, financing activities. Now sometimes there are a lot of non-cash transactions. For example, I issued shares to purchase fixed asset. I issued shares to purchase fixed asset, that has to be disclosed separately. Then, if there are exchange gains or losses in case of foreign currency transactions, generally not tested as a part, but still, foreign currency transactions, that has to be shown separately as a reconciling item. Okay, so that is as far as AS3 is concerned. I have put out a detailed video on YouTube covering the indirect method, which you can have a look at it, and also on the taxation part, that also you can have a look at it, right? So now what we'll do is we'll take a 5-minute break, and then we will resume with AS10. Okay, we will resume at 15:35. Right now there is a break. So at 15:35 we will resume. So Nasikesh is offering KitKat to everybody. Whoever wants can contact him. Any questions in the three standards, AS1, AS2, AS3? Simple standards, but AS2 again, highly scoring. I keep telling students that you should not miss that standard. It's a really high scoring standard, and it helps you to scale up the marks. It's okay, yeah. Nobody is asking you to give. No, they'll have their KitKat. So, how are your preparations going on? Whoever is currently live, how are preparations going on? What is the level of preparation? How many of you are thinking, no, we'll crack Group One and we'll crack our get exemption in advanced accounting? What is the strategy that is being built up? No strategy. Okay, Manoj says going good. I hope all of you have completed your syllabus by now, and all of you are in the revision mode. Sir, don't ask tough questions. Started preparation from yesterday. Okay. Uh, so please buckle up and try to finish as fast as possible. Ashwin, Group 1, Paper 6 and 8 exemption. I think you can target Paper 5 also, Ashwin. Looking at your past performance, you can say that you may get in 5 also. But sir, no use of Paper 5 exemption. That could be the thing, right? Seven also is good for exemption, by the way. If you know SM concepts well, MCQs can help you score exemptions in 7 also. But yeah, so to all of you who are writing examination in November and planning for exemption, I'll tell you, I think I've repeated this many times. Scoring 50 into 4 is much easier than scoring 60 into 2. This exemption target is unpredictable. It is not that we do not or we are not able to score, but this 60 target is unpredictable. Sometimes that question paper may be tough, and because of which we will not be able to handle that. So this target of 60 slightly becomes unpredictable. But apart from that, this is a slightly more reasonable is what I believe. Okay. But if you're feeling confident that yes, I can score 60 in both the subjects, please attempt. And all the best. I think you will be able to make it with your scores when I see at the foundation level. Others, anybody wants to share something before we begin? Okay. So now we start with AS10, which deals with property, plant and equipment. Now, what are property, plant and equipment? Very simple. What we have understood as fixed assets so far. We now have a specific term of property, plant and equipment. Property normally refers to your land and building. Plant and equipment, all of you know. Your machinery and equipments, air conditioning system, factory machinery, and all of that. No, examination time is already over, right? So if you have applied, apply. If you have applied for both the groups, write both the groups with full preparation. That is much better, I would say. Right now, What are property, plant and equipment? Property, plant and equipment are tangible items. So for intangible, we have a separate standard called AS26. Tangible items which are held for use in production or supply. Held for use in production or supply. If I am using a computer, for example, this computer that I am using to do this YouTube live, this I am holding it for the purpose of my business. So if I am holding it for the purpose of my business, for production of goods, my machineries, for supply of services, for rental purpose, for administrative purposes, all of these are called to be property, plant and equipment. So they have to be tangible. They are held for use in production or supply of goods, for rental to others, for administrative purposes. And they are expected to be used for more than one period, or for a period of more than 12 months, or for more than one accounting period. So PPE basically tangible items used for more than one accounting period, and they are held in the production or supply of goods or services, for administrative purposes and for rental to others. Now, one thing that you have to understand is, whenever we recognize property, plant and equipment, they must give me future economic benefits. They must give me future economic benefits. Only if I get future economic benefits, I can recognize the item as property, plant and equipment. Now tell me one thing, if I have this computer, I am a computer dealer, I buy and sell computers. Then this computer will be categorized as, if I am buying and selling computer, the computer that is being bought and sold will be categorized whether under property, plant and equipment or inventory. Where will I categorize computer for a computer dealer? I will categorize computer for a computer dealer under AS2, that is inventory. But if the same computer dealer is using this computer for accounting purpose, then it becomes a property, plant and equipment. Okay, so if it is a computer dealer, for him purchase sale of computers will be inventory. For billing purpose, it will be considered as, if I am using the computer for billing purpose, then it will be property, plant and equipment. Right. So this is the definition of property, plant and equipment. You will have to remember this definition. Now, the other thing that you have to understand is, as far as this standard is concerned, very importantly, AS10 does not deal with biological assets related to agricultural activity other than bearer plants. Very complicated way of defining. So let me just simplify it. There is a biological asset. So why are we reading biology in AS10? Biological asset, your living animal or plant. Biological asset, living animal or plant. Now, living animal or plant may be cows, buffalo. I cannot draw all of them. I am not good at drawing. Okay, then let us say trees, paddy. All of these are living animals or plants. Now, there is one plant called bearer plant. What is this bearer plant? Bearer plant is something, whenever you hear this bearer plant, remember a mango tree or apple tree, whichever fruit you like, which is one tree which gives you fruit on a recurring basis. Bearer plant, let us say mango tree. If I get this bearer plant, if I have this bearer plant which gives me fruit for more than 1 year, greater than 1 year, if I get more than 1 year or more than one accounting period, more than 12 months actually, right? This is called a bearer plant. If it is a bearer plant, then it is covered by AS10. If it is any other biological asset which is related to agricultural activity, that is not covered under AS10. So, biological assets related to agricultural activity is not included under AS10. Biological asset related to agricultural activity is not included under AS10. But bearer plant, if it is related to agricultural activity or not related to agricultural activity, it is considered or it is included under the scope of AS10. Okay. Now, if for example I have cows. Cow is a biological asset related to agricultural activity I use for dairy, milk production and all of that. If it is a biological asset related to agricultural activity, for example cow, that will be considered as a biological asset related to agricultural activity and not included. But tell me one thing, if I have a dog, if I have a dog and the work of that dog is for security purpose, I have purchased a dog to safeguard my office premises. Now, whether that dog, it's a very important question. If you have understood this part of the definition you have understood properly. If I have a dog for my office security purpose, whether that dog will be considered to be a property, plant and equipment under AS10, or is it outside the scope of AS10? See, I said if it is a cow for milk, you will keep it out. But if it is a dog for security, then whether it is included in AS10 or not included in AS10, that is the question. So think through, let me know the answer, then we will see what is the actual thing. Okay. So the standard does not deal with biological asset related to agricultural activity other than bearer plant. Bearer plant are included. So this orange tree or mango tree, whatever you have drawn, this is included. Wasting assets, mineral rights and all of those are not included. And investment property, outside, inside, outside, inside. Okay, we have both the views. Okay. Dog for security purpose is not for agricultural activity. So that is included under AS10. If it is an asset for agricultural activity, then it is excluded. So what is included? Bearer plant and any other biological asset which is not for agricultural activity, that is included under AS10. Okay. Now, investment property should be accounted for using this particular standard under the cost model only. So investment property is basically land and building which you have taken it for the purpose of giving it out on rent, for capital appreciation and all of that. So for land and buildings, you will use the cost model only. You will not use the revaluation model. But for what? Investment property. So let me summarize this. Sometimes it can be tricky. If it is investment property as per AS13, which is land and building for rent or for capital appreciation, I will use cost model only. I will use cost model only. I will not use revaluation model. I will not use revaluation model for investment property. If it is my office building, office building is not for investment purpose. So office building will be considered, you can use the cost model or you can use the revaluation model. Both of them are perfectly fine, right? So this is as far as the scope is concerned. And what is a bearer plant? Bearer plant is a living plant that is used for the production or supply of agricultural produce, is expected to bear produce for more than a period of 12 months and has a remote likelihood of being sold as an agricultural produce except for incidental scrap sales. For example, meaning to say, mango tree, my objective is to get mangoes, not to cut the mango tree and sell it as a timber. Okay, so that is what is the bearer plant. Now, whenever we talk about recognition of PPE, that is accounting for PPE, the general recognition criteria is there should be future economic benefits and cost can be measured reliably. Generally, cost of a property, plant and equipment can be measured reliably. There is no problem at all. Generally, cost of property, plant and equipment can be measured reliably. There is no problem at all. This is what you have to demonstrate. I must get future economic benefit. Now, say for example, in the studio, I have a AC. Now that AC will not give me future economic benefit. AC will not give me future economic benefit. But then sir, why do we show it at property, plant and equipment? Why do we show it as a property, plant and equipment when it doesn't give me future economic benefit? The reason is it gives me indirectly, it supports my operations. Without this AC, I will not be able to sit in the studio and take the lecture for so long. So that helps me in my operations, that helps me to deliver lectures to you, that facilitates my operation, that is for administrative purpose, and hence that is an item of property, plant and equipment. Okay, so that is the general criteria. Then if there are spare parts of standby equipment or servicing equipment, if they meet the definition of PPE, means future economic benefits and cost can be measured reliably, then you will recognize them as PPE. Otherwise, you will classify them as inventory. That is more or dependent on how the management views these particular items. Right now, some property, plant and equipment are required for safety and environmental reasons. These are not giving us direct economic benefits, but these are required for obtaining future economic benefits, and hence these are also items of property, plant and equipment. Right? So that is the criteria for initial recognition. And when we initially recognize means when we pass the journal entry, what do we need? We need the amount. We need the amount. Now for amount, if we have paid the money and we have purchased the asset, so in examination you can get 2 or 3 types of question. One is purchase, one is construction, one is exchange. If you have paid money and purchased, the same formula that you have understood as inventory or the same formula that you have considered for inventory, same logic applies here. So what you will take? Purchase price, non-refundable taxes, delivery, all of this, all the cost incurred to bring the asset or the PPE to its condition and location as intended by the management. So all the cost attributable to bring the asset to the location and condition necessary to operate for its purpose as intended by the management, this and all other cost, your assembly cost, professional fees, borrowing cost if it is permitted by S16, cost of testing, all of these are included and considered as cost of PPE, that is property, plant and equipment. Now EV of decommissioning cost, I'll deal with it separately. This is one very important item. Okay. Other than that, it is very, very simple. But please remember, the cost has to be incurred to bring the asset to its current condition and location. Now, if for example, if I have incurred some cost which does not help me to bring the item to its current condition and location. For example, there is an opening ceremony that is not required to make the asset to to its current condition and location. So opening ceremony related cost you will not capitalize. Okay, opening ceremony related cost you will not capitalize. Then similarly, let us say you have cost related to, let us say there is a land. The land is vacant for some point of time. You have given it out as a parking lot. That is also not necessary. So you will not adjust that income from the cost of that asset. So only those costs which will help me to bring the asset to the location and condition to operate for its purpose as intended by the management, only this cost should be included. All other costs should be expensed. Then we will understand in AS16 that borrowing cost can be capitalized, and government grant, if you have received, you can reduce the government grant from the specific asset, and if you have received the trade discounts, you will also reduce that. PV of decommissioning cost, I will handle it separately. Right now, some costs are specifically excluded. For example, conducting business in a new location with a new class of customer. So if you have to conduct business in a new location, for that you have incurred some cost, that is not a cost of PPE. Similarly, if you are introducing a new product, cost incurred for that is also not your PPE. Then cost of opening a new facility, ribbon cutting ceremony, not a PPE. Any other administrative or general overhead expenses, they are also not considered. Then if there are income and related expense of incidental operations like giving it out on parking and all of that, those are recognized in P&L. So that is how you will do the accounting for your asset. Okay. Now one very important item here is present value of decommissioning cost. Present value of decommissioning cost. Now what is this present value of decommissioning cost? Let us say we are standing today 0 and this is year 10. We have taken a site on which we have built a refinery. Not a very good drawer. Okay, animation team does a very good job in that. Right. So there is this factory which we have set up. This is a refinery. We have built the refinery on a land where we will be processing crude oil, and oil gives out a lot of pollutants. The nearby environment will get damaged and all of that. So what the government says is, or what the government says, or when they gave the permission, what they said is, you use this site. Let us say we can build this, use this site for 30 years. For 30 years we have built this particular project. No, not 30. I will make it 10 only. Calculation will be very long. 10 years. What the government says is, after 10 years, when you hand back the land to me, remove this structure, clean the area, restore the environment, maybe build some park or something like that, and hand it back to the government. Means You do some decommissioning activity, means break this down and take it away. We call it decommissioning activity or restoration activities. You carry out all of this when? At the end of the 10th year. At the end of the 10th year. Now understand this. This expense in the 10th year, let us say, is 1 lakh. This expense in the 10th year is, let us say, 1 lakh. What the standard says is, this 1 lakh of cost you are incurring because you are building this today. Because you are building this today, you have an obligation, and this is not avoidable. This is not an operating expense. That is a non-avoidable expense that the government has said you have to incur that expenditure. So this 1 lakh of cost that I am incurring after 10 years is because of this particular property. So what the standard says is, the present value of this should also be added to the cost of PPA. So why should we add it to the cost of PPA? Can we not directly expense 1 lakh when we spend it? Then the matching concept will be violated, because I have got the benefit from this particular property for 10 years. So this cost also should be apportioned over a period of 10 years, and the best way to do that is to add it to the cost of PPE so that it gets depreciated. Now we cannot add 1 lakh because it is an expenditure after 10 years. So what do? We discount this, we bring it to the present value. We bring it to the present value and add it to the cost of PPE. Now present value is equal to future value divided by 1 plus rate of interest, let us say 10%, to the power of 10. So you can take a calculator. 1.1 into is equal to 10 times. So 1.1 to the power of 10, we get 2.5937. So 1 lakh divided by 2.5937. So if I take 1 lakh divided by 1.1 to the power of 10, I get 38,554. 38,554. Okay. Now this 38,554, whatever amount I have got, I'll add it to the cost of PPE, and this automatically gets depreciated over the 10-year period. Now the entry will be PPE debit 38,554 to liability for decommissioning 38,554. Okay. Now this 38,554, what you have to do is opening balance 38,554. Every year you will have to add interest at 10%. So first it will be 38,555. So your closing balance will be 38,554 plus 3855, 42409. Like this you do it for every year. 42409, interest 4241, keep on adding it. At the end of 10th year you will get 1 lakh, right? This interest will be charged to PNL every year, and depreciation will be calculated on the amount including 38,554. That is about the decommissioning liability. In case if you have any question on that, please let me know. Right. So that is the first part. The second part is, if you have self-constructed PPE. Self-constructed means the company itself or the entity itself is constructing the property, plant and equipment. Now in that case, you will take all the cost of construction that relate to the asset, the cost which can be allocated to the construction activity, including allocation of your construction overheads, then borrowing cost if it is qualifying asset as per AS16, but you should exclude any internal profit and any abnormal amount of wasted material, labor and other resources. Internal profit means, for example, labor. Market, if I take the labor from market to build my plant, I have to pay 10,000. My cost of the labor is only 8,000. So I will take 8,000, I will not take 10,000. So that is what is the thing you have to exclude. Internal profit should be excluded. Then sometimes what happens is, we get property, plant and equipment by exchanging non-monetary assets. We get property, plant and equipment by exchanging non-monetary assets. Now if there is an exchange transaction, how do we account for it? Always check the fair value of asset given. For example, I have a pencil. I have a pencil, this particular pencil. This pencil, if I am giving it to you and I am buying something else from you, for example, you gave me another thing, let us say you gave me a watch. So, I have given you pencil and you have given me watch. So, what is the fair value of pencil? This is the first preference I will take. This is the first preference I will take. If fair value of pencil is not available, then I will take what is the fair value of the watch. In non-monetary exchanges, asset given up, if that is evident, okay. If asset given up is not available, not given up, not evident, take asset received and then you will account for it. But one thing you have to consider is, does the transaction have commercial substance? Commercial substance means after exchanging the assets, your cash flows or my cash flows, they should undergo a change. The timing of the cash flow, the risk associated with the cash flow, the amount of cash flow, all of that should undergo a change. So, in that case, what do we say is, if it has a commercial substance, if it has a commercial substance. Now, what is the meaning of having a commercial substance? I gave you a pencil. You also gave me a pencil. Then there is no commercial substance. My cash flows do not change. So, the commercial substance condition is not satisfied. But I gave you a pencil, you gave me a watch. Or I gave you one machine, you gave me a different machine. In that case, commercial substance is met. So, whenever you have these kind of scenarios, what you will do is, first preference, if fair value of asset acquired or given up can be measured reliably, if fair value of asset acquired or given up can be measured reliably, what is more relevant, what is more reliable, you will take that and you will measure at it. So first you will always see that fair value of asset given up. Then if that is not there, fair value of asset acquired. If that is not there, if you cannot determine the fair value, then you will take the carrying amount. If you cannot determine the fair value, then you will take the carrying amount. If you cannot get the fair value, then you will take the carrying amount. If the transaction doesn't have carrying commercial substance, in that case also you will take the carrying amount of the asset which is being given up. So, exchange transaction has a commercial substance if the risk, timing and amount of the cash flows of the asset received are significantly different from the cash flows of the asset which are being transferred. Right. So, that is with respect to exchange of assets, where you have an asset given up. So, you will always see what am I giving, that is the first thing I will choose, and then if I cannot get that, the second thing is whatever I am receiving. But sometimes what happens is, if fair value of asset received is more evident, then you will take the fair value of asset received. More evident means what? Which has more evidences, which has more evidences, which you can determine properly. So that you will always consider. Right. Now, when do we stop capitalization? When do we stop capitalization? You will stop capitalization when the PPE is in the location condition which is necessary for it to be capable of being operating in the manner intended by the management. A simple example I'll give you. I purchased an air conditioner. Air conditioner, the cost of AC, the cost of transportation, the cost of non-refundable taxes, all of those costs I will consider. All of those costs I will consider and I will add it to the cost of PPE. Okay. Now, I got it, I installed it. Cost of installation also I will add. Subsequently, I did not like the location of the AC where it is being installed. I uninstalled it and again I installed it. Now that uninstallation and installation cost should not be added to the cost of PPE because that was not incurred for bringing the asset to the condition and location to be operated as intended by the management. First time installation, yes. Second time uninstallation and again installation, that does not add the value to the particular asset and hence that will not be added to the cost of property, plant and equipment. Okay. So once it is in the location and condition, these are very key terms, okay, you need to keep in mind. Location and condition necessary for it to be capable of operating in the manner as intended by the management, then in that case you will consider the cost after it is ready. We call it ready to use. Simple terms, we say once it is ready for use. So once it is ready for use, after that you will not include that in the cost of your you will not include the cost in property, plant and equipment. Subsequent cost whichever are being incurred will be taken to P&L if they are day-to-day repairs and maintenance. If they are replacement of part, existing part, you will de-recognize. New part you will add. For example, I giving this example. The camera, the battery for the camera is a significant component. Whenever I am replacing the battery, I will de-recognize the existing battery and I will add the cost of the new battery. Major inspections and overhaul are capitalized. So why are they capitalized? They are capitalized because they are expected to give us benefit for more than one accounting period. That is why they are capitalized. Generally, these major inspections and overhauls, in case of aircraft, ships and all of that, they are used, and they are required also. So you cannot fly an aircraft without having a periodic maintenance and overhaul. So over a period of 2-3 years, they give us benefit. It is capitalized and depreciated over those 2 to 3 periods. Any questions? So subsequent cost, day-to-day repairs P&L, replacement, you will recognize the existing part and recognize the new part. Major inspections and overhaul will be capitalized. Then another very important aspect, if there is a deferred credit period, deferred credit period means let us say today if you go and buy a PPE, you get the amount that will be charged is 10,000. Today if you go and buy a PPE item, amount that is charged is 10,000. You say I will pay after 2 years. I will pay after 2 years. What the supplier says is, if you buy after 2 years, you have to pay me, I am just calculating the amount, 12,100. Okay. Now I have to pay 12,100, but what is the cash price? This is called the cash price. Cash price is only 10,000. So what the standard says is, this 10,000 should be the amount of PPE, and the 2,100 should be your interest expense. Now how do we account for that interest expense? You will say 10,000 opening balance, interest 1,000, closing balance 11,000. 11,000 opening balance, I am considering 10% interest. 11,000 opening balance, 1,100 interest, 12,100 closing balance. So this 1,000 and 1,100, this will be my interest expense in the P&L. That will be my interest expense in the P&L. My cash price 10,000 should be the amount at which I should be capitalizing my property, plant and equipment. So if there is a property, plant and equipment purchased on credit terms beyond normal credit terms, sometimes what happens is 60-day credit, 90-day credit, those are normal credit terms. But if you are purchasing beyond normal credit terms, then the property, plant and equipment should be recorded at the cash price equivalent, and the difference between the cash price and the total payment is recognized as interest as required under AS 16. So it can be a qualifying asset, then you will add it to the cost of asset, otherwise you will expense it. Right. So till here we had this aspect related to property, plant and equipment items. The cost, how do we calculate the cost of purchased, cost of self-constructed, cost of exchanged assets and all of that. Now we have depreciation. Depreciation basically is nothing but allocation of the depreciable amount over the life of that asset. Depreciation is allocation of depreciable amount over the life of that asset. Now, if you purchase any asset, let us say we have purchased this at 1 lakh. Estimated residual value. Now residual value is nothing but what is the value that I expect to sell this particular asset. What is the value that I expect at which I can sell that asset of similar age. For example, 5 years is the life of that asset. How much can I realize by selling a 5-year-old asset today? Sir, why are we considering today? Because if we sell after 5 years and if we take that value, it will be a future value. We need today's value. So what the standard says, what is the value you will get by selling a 5-year-old asset today? That is called the residual value. Let us say 10,000. Balance is 90,000. This 90,000 is called the depreciable amount, and this 90,000 is allocated over 5 years. Different methods, straight line method, WDV method. So 90,000 divided by 5, if you do 18,000, this is the straight line method. Then carrying amount will be your cost, which is 1 lakh, minus depreciation, which is 18,000. You get 82. This is called the carrying amount. Carrying amount is cost minus depreciation, of course minus impairment loss, that is not tested as a part of your group 1 syllabus. Okay. Now this is how we calculate depreciation. Entities can use different methods like WDV method. 1 lakh is the cost. Entity may say 20% depreciation, WDV method, or reducing balance method. So 20% is 20,000. Now you have 80,000. On this you will charge again 20%, which is 16,000. So now you get 64,000. Like this you continue to charge depreciation under WDV method. Now what the standard also says is the depreciation should stop when the asset is retired from active use and is held for disposal, or the asset is derecognized. So when should we stop charging depreciation? The day I say I am no longer using this particular asset, I want to sell this asset. So if I have retired it from active use and held for disposal, or the date on which the asset is derecognized. Derecognized means either I have sold it off, or I am no longer carrying that asset in my books, it has been destroyed, whatever it is. So in these two scenarios, you will not charge depreciation. And commencement of depreciation is when the asset is available to use. That is, the moment it comes to the location and condition necessary for its being operated in the manner as intended by the management, we will charge depreciation. We will charge depreciation. Put to use, not put to use is not relevant. We will charge depreciation when it is available for use, and we will cease depreciation either when it is retired from active use or when it is derecognized. If the asset becomes idle, depreciation continues to be charged. And I'll pass group 1, but I'm losing knowledge of group 2 advanced account of old syllabus. Can we purchase inter-removed portion after exam? Yeah, we'll create some kind of bridge course for FM and advanced accounting, and we'll offer it to you. So don't worry about that. Okay. So for now, because though it has come in the chat box, if you're focusing on group 1 and you're worried that group 2 concepts you'll not be able to remember, the incremental group 2 concepts which are relevant for your FR final and FM contents which are relevant for your SFM final, that will be providing for those of you who want to refresh their knowledge. Don't worry about that. Right now focus should be normal 23 examinations. Okay. And for those of you who are not yet started in, who want to start, or who want a quick glance at various topics, right now we have today is the last day. We have a full group which is being offered at 4,999, and both the groups at 9,999. I made this announcement because of this question which came up. You can make use of this opportunity. Courses will be valid till November 15th. So 5,000, 4 subjects, valid till November 15th. That is around 70 days. So you can actually prepare whichever topics you want to prepare in depth. Okay. So that's a small thing. Available only today. Tonight the sale would conclude. After that it will be back to the normal prices. 4,999 per group. Okay. Now coming back to component accounting, depreciation. Sometimes what happens is you have an asset which has different component with different useful lives. For example, the typical example what we understand is aircraft, machine or engine. Engine has a 20-year useful life. Chairs has a 5-year useful life. Now, I cannot depreciate chairs over 5 years and aircraft over 20 years. Or I cannot do saying that 20 plus 5, 25. So, I will depreciate both of them at 12.5 years. That is not allowed. So, what the standard says is, calculate the value of engine, chairs. So, engine is, let us say, worth 100, chairs are worth 10. This you depreciate over 20, this you depreciate over 5. So, engine will be depreciated 5, this will be depreciated 2 per year. 5 years, chairs will become 0. Then what do we do? When the new chairs are brought in, existing chairs will be de-recognized and new chairs will be capitalized. Engine will be continued for 20 years. This is called component depreciation. In the balance sheet, you will not say engine separate, chair separate. In balance sheet, you will say aircraft only. But you will follow component depreciation. Or same thing is followed in case of building and painting. So a building and you have outer structure painting. Building has a life of 20 years. Painting has a life of only 5 years. So painting cost will depreciate over 5 years. Building cost will depreciate over 20 years. So if an asset consists of different and significant physical components, then if they have different useful lives, usage or flow of economic benefits, then each component should be recognized and depreciated separately over its individual life. Then one more important thing, land and buildings are separable assets and they are accounted for separately even though if they are purchased together. Land is not depreciable, building is depreciable, and accordingly you will do it. Then if the cost of land includes cost of site dismantlement, removal and restoration, that portion of the land asset is depreciated over the period of benefits obtained by incurring those costs. So this is a very minor aspect where you have purchased a land and then you have incurred dismantling cost. If you have incurred dismantling cost, you will estimate, okay, this dismantling cost will give me benefit for 10 years, 15 years, 20 years. Over that period, you will depreciate the dismantling cost. Then we have useful life over which the asset will be used. We have a residual value. The residual value is the estimated amount which can be recovered from the asset at the end of its useful life. It is the current estimate. It is not a future estimate. It is the current estimate. Now, if the residual value is greater than the carrying amount, for example, residual value became greater. Subsequently, when we re-estimated the residual value, it became greater than the carrying amount. You will not charge any depreciation. You will not charge any depreciation. If the fair value is greater than the carrying amount, you will continue to charge depreciation. So this you can ignore for your exam point of view. This is more important. If residual value is greater than the carrying amount, you will stop charging depreciation. You can have straight line method, diminishing balance method, unit of production method. In unit of production, what you do is, let us say you have 10 units, 20 units, 30 units. In this ratio, you will charge depreciation. Very simple. Now, if there are additions or extensions to an existing PPA, how do we charge depreciation? If it cannot be used independently, you will use the existing asset and that life and you will depreciate it. For example, there is a spare part for a machine. That spare part can be used only for that machine. Then in that case, you will charge depreciation over the remaining useful life of the existing asset. But if it is an independent asset which can be used separately, then you will charge depreciation based on its own life. Very important next aspect, measurement, either cost model or the revaluation model. Cost model means what? You will take the initial cost, accumulated depreciation, impairment loss, you get the carrying amount. What is revaluation model? Under revaluation model, what you do is, every period or as per defined policy of the company, you will calculate the fair value on the date of revaluation. Cost may be, let us say cost may be 1000. The fair value means the value at which we can exchange that asset or we can dispose of that asset can be 1200 or can be 800. So we will recognize the asset at 1200 or 800. So what you will do is, you will calculate the fair value on the date of revaluation. Then subsequently you will start charging depreciation based on the. sorry, a minor accident. Yeah. Subsequently, you will charge depreciation and impairment on the revalued amount. Okay. Now, how do we do the revaluation? I'll just show you once. Let us say cost is 1 lakh, depreciation is 20,000, carrying amount is 80,000. Then you determine what is the fair value. The fair value, let us say, is 90,000. Yeah, I'm okay. Only the camera fell down. Fair value is, thanks for your concern, Amit. Fair value is 90,000. So this is called the revalued amount. Is called the revalued amount. Now what happens is after the, so let us say this life is 5 years. Now fair value is 90,000. Subsequently, I will take 90,000. Out of 5 years, 1 year is completed. So divide by 4, I will get 22,500. This will be my revised depreciation. That is how it works. Now, how do we account for revaluation? How do we account for revaluation? If the first time revaluation is an upward revaluation, means it was 80,000, now it has become 90,000. If it is upward revaluation, what I will do is the gain of 10,000 I will not recognize in P&L, I will recognize it under revaluation surplus directly in under reserves and surplus. It will not be taken to P&L. So it will be credited to revaluation surplus. Which one? The first time upward revaluation. First time if it is downward revaluation, if it is a loss, I will account for it in the P&L. So upward revaluation, revaluation surplus, downward revaluation, charge to P&L. Charge to P&L. Okay. This is for the first time. So entry will be PPE to revaluation surplus. If it is increased, I have to increase PPE by 10,000. I will show revaluation surplus 10,000. If it is loss, means if the value goes down, debit P&L, credit PPE. That is the first case. Now, subsequent revaluation is where you have to pay extra attention. If first time it is upward revaluation, subsequently also it is upward revaluation, then no problem. You continue to add it to the revaluation surplus. First revaluation, subsequent upward, first upward, subsequent upward, add it to the revaluation surplus. Then, if first is upward, second is downward. Upward means first time I charged 10,000. I don't know why am I writing 1 lakh for 10,000 every time. First time it is 10,000 surplus, upward revaluation. Now it is 15,000 downward revaluation. 15,000 downward revaluation. Then in that case, what do we do? Then in that case, the 10,000 upward revaluation surplus which is available, we will use for this downward revaluation. So existing surplus I will use 10,000. Balance, see again I am writing 1 lakh. Existing surplus I will use 10,000 and balance 5,000 I will transfer to. Okay. So if first upward, subsequent upward, no problem. If first upward, subsequent downward, use existing surplus, balance transfer to P&L. Right? Then, if first time it is downward, subsequent it is downward, debit to P&L, no problem. But first time it is downward, let us say 10,000 downward, we are debited to P&L. Now we have to do 15,000 upward. Then what we will do is, whatever you have charged to P&L earlier, 10,000, you will credit to P&L and balance 5,000, I will take it to revaluation surplus. So this is how we do the accounting for revaluation, either upward or downward. Just to summarize, upward revaluation surplus, downward P&L. Upward to upward, downward to downward, no problem. First upward, then downward, whatever we have taken to revaluation surplus, when we are doing the downward revaluation, you will utilize the revaluation surplus. Utilize means, see, whenever there is a loss, we debit the P&L. But here what we will do, instead of debiting the P&L, we will debit the revaluation surplus. Any questions here? I hope this revaluation surplus component is clear now, how to do upward and downward. Now, continuing with this example, my 80,000 of asset has now become 90,000. So there are two ways to do it. One way is, because 80,000 has become 90,000, what I will do is, I will say debit PPE 10,000, credit revaluation surplus 10,000. Right. Then this 20,000. So when we charge depreciation, what do? We debit depreciation 20,000. We credit accumulated depreciation 20,000. This accumulated depreciation is transferred to PPE. So we will debit accumulated depreciation 20,000 and we'll credit PPE 20,000. Okay. So you will have to transfer the accumulated depreciation to the PPE. You will have to transfer the accumulated depreciation to the PPE. So you will debit accumulated depreciation and you will credit PPE. Right. So what will happen? PPE from 1 lakh, this depreciation will be transferred and adjusted against that. It will come down to 1 lakh minus 20,000, 80,000 plus 10,000. When you do, you will get the 90,000. That is the net method. Another method is the gross method. What does the gross method say? See, 1 lakh is the cost, 20,000 is the depreciation, 80,000 is the carrying amount. Now this 80,000 I am making 90,000. So when I make 80,000 to 90,000, 90,000 divided by 80,000, what is the change? I am doing multiplying it by 1.125 times. So here also what I will do, I will multiply this by 1.125 times. That will give me 1,12,500, and this also 1.125 times. When I do, I get 22,500. So in the second scenario, what we will do, we will debit PPE by 12,500. We will credit depreciation accumulated by 2,500 and we will credit revaluation surplus by 10,000. So this is one method. Other method is directly we will take 10,000 and 10,000. In examination, you can follow whichever method is comfortable. This is the method I would suggest to be followed in the examination. Then, what do we do with the revaluation surplus? Revaluation surplus you can transfer to the retained earnings on year-to-year basis. That is, revised depreciation for us was 90,000 divided by 4, which is 22,500. Original depreciation for us was 20,000. So 2,500 is the extra depreciation. Every year you can debit revaluation surplus 2,500 and credit retained earnings 2,500. Or at the end of the life of the asset, you can debit revaluation surplus 10,000, credit retained earnings 10,000. Either ways can be followed. Okay, so you can transfer that periodically or at the end of the period to the retained earnings. You will not take it to P&L. Please keep that in mind. You will never ever take that to P&L. Any questions? Then de-recognition. So whenever we learn a standard on asset, you have recognition, measurement, subsequent measurement and de-recognition. Recognition means accounting in the book. Derecognition means throwing it out of the books. Not in literal sense. Throwing it out means derecognizing. That asset we are no longer using. Because we are no longer using that asset, we don't need that asset in the books of accounts, so we have to derecognize. Now, on derecognition, when do? We do it on disposal, means we have sold the asset, or when no future economic benefits are expected from the use or disposal. See, when I am recognizing an asset in my books, what am I telling to my shareholders? I am telling to my shareholders that we will get future economic benefits. We will get future economic benefits, correct? If I don't get future economic benefits, it is not my asset. So I have to write it off, or I have to derecognize it from my financials, right? So when I have to derecognize it from my financials, just a second. When I derecognize it from my financials, I have to move it out from my books of accounts. So what happens is, if carrying amount is 80,000, sold at, let us say, 1,20,000, 40,000 of gain will be recognized in the P&L. For cash flow purpose, 1,20,000 is considered for AS3, but for P&L purpose, we will consider 40,000. Okay. Disclosures, you can run through it once. So here, this on exchange. Entity A exchanges car X with a book value of 13 lakhs and a fair value of 13 lakh 25,000 for cash of 15,000 and car Y which has a fair value with 13 lakh 10,000. The transactions lack commercial substance because the company's cash flows are not expected to change as a result of exchange. So when cash flows are not expected to change, what you will do is, time is running out for what? If it is not expected to change, then what happens? You have given car X 13 lakhs, and because it doesn't lack it, I will end at 5 and I'll continue whatever is left over 1 or 2 standards. I'll schedule a date subsequently and I'll complete that. Don't worry. Car X 13 lakhs has been given up. See, whatever I am teaching now, please absorb that. In fact, this we have already done it in the past also. So the previous accounting standard revision covers again AS1. All the standards are already covered. The live was here to again have a interaction with you and do it on a fast track basis, right? So again, coming back, 13 lakhs is the asset given up. Okay, we have given up, and car Y we have received 13 lakh 10,000. Now, if the transactions lack commercial substance, what do? We will take the carrying amount of the asset given up. So what did we give? We gave car X. What did we get? We got cash of 15,000 and we got car Y. So car X when I gave for 13 lakhs, 15,000 I got in cash. So balance 12 lakh 85,000 pertains to my value of car Y at which it should be recognized. Others we have discussed. You can have a look at this the practice thing. So a lot of theory questions that you need to see. Now here, land, roof, lift, fixtures and remainder of the building, you have different lives given and different cost given. So this will not be depreciated, the land portion. Others, based on their useful life, you will depreciate each item separately. This question, Srishti Limited contracted with a supplier to purchase machinery which is to be installed in its department in 3 months' time. Special foundations were required for the machinery which were to be prepared within this supply lead time. The cost of site preparation and laying foundation was 141. This will be added. These activities were supervised by a technician during the entire period who is employed for this purpose, 45,000 per month. Technician services were given by Department B to Department A, which billed 49,500. Now tell me, should I take 45,000 as my cost or 49,500 as my cost? Because department B has charged me 49,500. Which one should we consider? Then please respond to this. The machine was purchased at 1,58,000, 1 crore 58 lakhs 34,000 inclusive of IGST of 12%, for which input credit is available. So 158,34,000 is inclusive of GST, means if 100 is the base price plus 12 is the GST, total is 112. 158,34,000 is 112. How much is 100 is what we need to calculate. We will always consider it at cost. We will not consider it at the profit portion. Internal profit, see, department A, department B, both of them are within the organization. So you will not consider the internal profit that is being generated. So you will consider at 45,000 only. 100 is how much? So 158,34,000 divided by 112 into 100. You get 141375,000. 141375,000. So 158,34,000 divided by 112 into 100. This is the cost. Site preparation included. Supervisor salary, we missed 3 months. See, I was only thinking 1 month. Per month, 3 months time. So you should not miss this also. Okay. So supervisor salary for 3 months. Then 55,770 was transportation charges and architect 30,000. So both of these are included. So this will be the cost as per the accounting standard. These calculations, be careful. Now moving on to accounting standard 11, effect of changes in foreign exchange rates. Now AS11 as such, again very important. You also get questions on foreign branch accounting and all of that, which is somewhere related to the principle of AS11. When we talk about accounting standard 11, so you have something called as foreign currency and then something called as the reporting currency and the functional currency and all of those aspects. Now what we have to understand is, whenever there is a foreign currency transaction, how should we account for it? That is what is covered by this standard. For example, if we export, if we import, how should we account for it? Or if we take a loan in foreign currency, how should we account for it? So that is what is covered by AS11, right? Now there are some definitions we need to understand before we move to the details of the standard. One is monetary items, second one is non-monetary items. Notes are available in free resources. The same notes may not be available. I will see if I can extract the accounting standards notes and I can provide it to you as a part of this session, because these are our paid notes which are given to paid user, but still AS notes I will see if I can extract it and I can share it with you as a part of free resources. Where were we? Monetary items. Okay. Now what are monetary items? See, the way you need to understand monetary and non-monetary item is something which is determined in terms of money, and if the monetary value, the money that you will receive, it doesn't change, that is called monetary item. For example, I sold some goods to a customer. Customer has to pay me 10,000. The 10,000 is a monetary item because customer will pay me 10,000. Sir, what if he doesn't pay me, if he goes bankrupt? That is insolvency case. That we will handle separately. But what am I expected to receive? 10,000. That amount is fixed? Yes. Will that amount change? No. So that is called a monetary item. If I have exported some goods, I have to receive $10,000. Will that $10,000 change? No, that $10,000 will not change. See, ultimately on conversion I may receive something else, that's a different thing. But that $10,000 will not change, and hence that $10,000 will be considered to be a monetary item. Compare this with an inventory item. Inventory, if I am saying it is 10,000, the money that I will receive on selling inventory may be different. So, monetary items are money held and assets and liabilities to be received or paid in fixed or determinable amounts of money, cash, receivables, and payables, loans, and all of those. Whereas non-monetary items are items like fixed asset, inventory, investment in equity shares, where the amount of money that you will receive is not determined. The Excel sheet, where is the Excel sheet? PDF. Excel sheet I use in the class. Okay, yeah. So you have monetary items, non-monetary items. This distinction is important because subsequently we'll realize that all monetary items in foreign currency, they have to be restated. So this also we will understand. Okay. Now, basics I'll tell you how do we handle this thing. If for example Infosys sold $1,000 worth of goods to a US based customer. To a US based customer. So what will be the accounting entry? What is the accounting entry for sale? Sir, what simple question? I have seen students, or not students actually, qualifieds not being able to tell me journal entries of depreciation. So what is the entry for recognizing sale? Journal entry? Sir, we don't have journal entry. We only post it in subsidiary or sale book. So we don't have journal entry. Come on. Cash to sales, okay. So when you have to account it, cash to sales, if you have not received cash, we will say customer debit to sales, okay. Now the problem is, this is $1,000. Infosys has to prepare its books of accounts in rupees. So what the standard says is, take the rate of conversion on the date of transaction. So today, if $1 is equal to 85, what do you do? 85,000 to sales. 85,000 in rupees. Okay, customer to sales 85,000, 85,000. Now, on 31st March, this is still outstanding. On 31st March, this is still outstanding. Then what do we do? On 31st March, what the standard says is, if there is a monetary item, you will restate at closing rate. Now, in customer and sales, which one is a monetary item? In customers and sales, which one is a monetary item? Customer is a monetary item. So let us say on 31st of March, the rate of exchange is 86. I sold when the rate was 85. I have to receive when the rate is 86, which means there is a gain. So what the standard says is, this customer is now worth 86,000. I recognize at 85,000, it is 86,000. So 86 minus 85, 1,000, you increase the value of customer. 2, gain on foreign exchange. 1,000. Exchange gain, we call it 1,000. So at the end of every accounting period, you will remeasure all foreign currency monetary items at the closing rate. Then let us say on 1st of May, customer paid $1,000. The rate was 82. Now tell me, how much is the loss? I sold when the rate was 85. Then I said I have to receive at 86. I took the value to 86,000. I took the value to 86,000. Now, when the customer paid me only $1,000. Customer paid me only $1,000. So, when the rate was 82. So, the amount that I have received in bank is 82,000. to customer having a value of 86,000, but I received only 82,000, so there is a loss of 4,000. There is a loss of 4,000. Net loss is 3,000. 4,000 of loss here and 1,000 of gain here. Net loss is 3,000. Sir, what? It is not foreign exchange translation reserve. No. It is the gain or loss that we take to P&L. Sir, why are we not applying prudence concept? We are not applying prudence concept because that is the amount that I have to receive. So it is a dollar amount. This dollar amount I have to translate to rupee. I have to receive $1,000 from someone. How will I show it in the balance sheet? If I have to receive $1,000 from someone, how will I show it in the balance sheet? In the rupees terms. When I have to convert that to rupee, I have to take the closing rate only, right? Because on the balance sheet date, the rupee equivalent of dollar is 86. So I will show it at 86,000. In final, you will understand that there is a concept called forward, future and all of that, with which you can actually log this rate also. If you want, on that date you can log this rate also. So here we are actually valuing our monetary items using the balance sheet rate, because I cannot say it is $1,000 in my balance sheet. I have to say using the closing rate, which is 86,000. How much am I expected to receive on the date of the balance sheet? So that is how we do the accounting for it. What is a foreign currency? Foreign currency is a currency other than the reporting currency of the enterprise. So here, reporting currency is INR, foreign currency is the USD. Reporting currency is INR, foreign currency is USD. Now, what are foreign currency transaction? Foreign currency transaction is a transaction which is denominated in or requires settlement in a foreign currency. Denominated in means I sold the goods in dollars. It is a foreign currency transaction. Or it requires settlement. I have to pay dollars or I have to receive dollars. That is a foreign currency transaction. So when you buy or sell goods or services, when you borrow or lend money, when there is a forward exchange contract, you can ignore it for now. For the examination, not very important. Or you sell asset or settle liability in a foreign currency. Initial recognition of a foreign currency. A foreign currency transaction should be recorded on initial recognition in the reporting currency by applying the foreign currency amount, the exchange rate between reporting currency and the foreign currency on the date of transaction. So in our case, 85 was the rate of transaction. We should account for the foreign currency transaction using 85. Then, at each balance sheet date, monetary items are reported using the closing rate. Monetary items are reported using the closing rate. What about non-monetary items? Non-monetary items are stated using the rate on the date of transaction or the historical rate itself. Now sir, why do we have to report a non-monetary item? Sometimes what may happen is you may have made investment or investment in shares, which is in dollar terms. That is a non-monetary item. Or you may have a fixed asset. Using the revaluation model. You need dollars for that. Okay. Or you may have something like an inventory, crude, which is valued in dollar. So if there are non-monetary items, then what do? You will show it at if it is at historical cost, you will use the exchange rate on the date of transaction. If it is historical cost, you will use exchange rate on the date of transaction. For example, I have invested when the dollar rate was 85. You will show the investment shares at 85 only. Then, if it is carried at fair value or other similar valuation denominated in foreign currency, for example, fair value of PPE under revaluation model, then what was the rate when the value was determined? Take that rate and report. So, for revaluation cases, take the date of revaluation and consider that rate and account for the and report it using the same basis. Then, if it is a contingent liability, which is anyways disclosed using the closing rate, right? So, if it is historical cost basis, date of transaction. If it is fair value or other valuation, like say NRV, inventory is valued at over of cost and NRV. So, using that basis, you will report that using the exchange rate on which those values were determined. Now, exchange difference. There is an exchange difference because you have reported something using one rate. Now you are reporting the same thing using some another rate, which is a exchange difference. Now exchange difference, whenever there is a monetary item, then you will recognize it as an income and expense in the period in which they arise. For example, on 31st of March, in the example that we took, 1000 of gain was recognized in P&L. Subsequent loss was also recognized in P&L. So monetary items, you will recognize the gain or loss in the P&L. Okay. Then if there are long-term foreign currency monetary items in relation to a depreciable asset and other asset. Now, what you have to understand here is, if I have taken a loan, is loan monetary or non-monetary? Loan is a monetary item. If I took a loan of $10,000 when the rate was 80, now on 31st of March, this $10,000 of loan is now at 82, which means 21212, 20,000 of loss. This 20,000 of loss should be recognized in P&L. This 20,000 of loss should be recognized in P&L. But then what happened was, this was way back in 2008, when companies were facing lot of losses because of foreign currency fluctuations. People borrowed money, and they had borrowed money, the dollar rate shot up, and because of which there was a lot of losses. So for that, what they have done is, there is an option that exchange difference arising on reporting of long-term foreign currency monetary items. That is, it has to be long-term foreign currency monetary item, basically a loan, which is a foreign currency loan, in relation to a depreciable asset. In relation to depreciable asset means what? I took the loan for buying a depreciable asset, plant and machinery. So if there are exchange differences which are arising on reporting of long-term foreign currency monetary items, then there is an option which is provided which say that it can be added to or deducted from the cost of asset and should be depreciated over the balance useful life. This is an option. This is an option provided. What does that option say? The option says that this loss of 2 lakhs, you have an option to add or reduce from cost of asset. So what is the meaning of it? See, we took a $10,000 loan. Now the loan liability has increased by 20,000. Normally we said this loan liability we will debit P&L, credit loan. Now what the standard says is, at the option of the entity, if they want, and it is one-time non-reversible option, instead of debiting it to P&L, you can debit it to asset. You can increase the cost of the asset, you can reduce the cost of the asset. You can increase the cost of the asset, or you can reduce the cost of the asset by not transferring that to P&L. So this is a one-time option which has to be exercised, and you cannot reverse it subsequently. Okay. So if they are related to acquisition of a depreciable capital asset, you will add it or deduct it from the cost of asset, and the revised amount will be depreciated over the life of that asset. In other cases, means which is not a depreciable asset, let us say land or any other asset which is not depreciable, but it is a long-term item. In that case, exchange difference can be accumulated in FCMI-TDA account. FCMI-TDA account, foreign currency monetary items translation difference account. So you will accumulate it and amortize over the balance period of the asset or liability by recognizing an income and expense in that period. But what it basically means is, if it is for a depreciable asset, you can add that 20,000 of loss to the PPE. If it is not a depreciable asset, you take FCMI TDA account, you will debit it by 20,000. Then over the period of asset or liability, means whichever you want to do. If it is, let us say a monetary item which is a liability, over the period of liability from FCMI TDA account you will debit PNL, means you will depreciate or amortize it over the balance useful life. Is that clear? So this chart summarizes whatever we have discussed. Is that clear? Okay. Right. Then there could also be foreign operations, like we have a foreign branch or there is a foreign subsidiary. So there can be foreign operations like a branch, a foreign branch or a foreign subsidiary, which is integral foreign operation and also non-integral. There are two types of foreign operations, right? Now the thing is, what happens is, if it is an integral foreign operation, you have one way of translation, means you have a head office. The head office has a branch. Branch will prepare its trial balance. This trial balance has to be translated. See, this will prepare a USD on USD. You have to translate that to INR. Now, it depends on whether it is integral or non-integral. How should you translate it? This, of course, you will understand again in foreign branches, right? Now, when do we say that a foreign operation is a integral foreign operation or a non-integral foreign operation? Okay, the best way to understand is how much is the foreign operation dependent on the parent or on the entity. For example, I have a branch. That branch is fully dependent on me. The branch is fully dependent on me, like a small kid. For everything, the branch has to come to me. For money requirement, the branch has to come to me. If they want to buy something, they have to take approval from me, or I will only supply them everything. Fully dependent, then it is called integral foreign operation. But if they are independent, someone like a teenager, like all of you, right? All of you are generally, other than money requirement, all other decisions you take it on your own, correct? So you are more independent. So that will be an independent branch. You will just take the money from the head office, from your parents, then you will decide which phone to purchase, which class to enroll for, which movie to go to, correct? When to give party, where to give party. All of those are independent decisions. So when a foreign operation has a significant degree of independence, then it can be a non-integral foreign operation. Or the transactions with reporting entity are not large in number. You just take money from your parents, then you spend with outsiders. Or the operations, that is the operating expenses, are paid in local currency, or sales are mainly in their local currency and not in the reporting currency. Sales price are determined based on local competition. Activities funded from profit from its operation or from local borrowings largely, then it is called a non-integral foreign operation. Now, when it is an integral foreign operation, it is like my own extension. When it is an integral foreign operation, it is like my own extension. So, if it is an integral foreign operation, how do we translate? Individual items in financial statement are translated as if all transaction had been entered by the reporting enterprise. So, you will translate as if all the transactions have been entered by the reporting enterprise, that is the head office. For assets, exchange rate on the date of transaction, on the date of purchase. Inventory, as and when the cost were incurred. If you have to calculate any recoverable amount of an asset, for example, inventory, exchange rate when the when the recoverable amount was determined. So if it is an integral foreign operation, you will translate all the items, basically whatever is the rate on date of transaction. On that basis you will translate. But if it is a non-integral foreign operation, assets and liabilities, closing rate, income and expenses on date of transaction, exchange differences you will accumulate in foreign currency translation reserve account, whereas in case of an integral foreign operation you will take it to your P&L. Goodwill, closing rate, contingent liability, closing rate. So everything will be at closing rate. Income and expenses will be on the date of transaction or using an average rate. Any exchange differences will be accumulated in foreign currency translation reserve account. Then, if you are reclassifying a foreign operation, means from integral foreign operation to non-integral foreign operation, or from non-integral foreign operation to an integral foreign operation, what you will do is, if it is integral and now it has become a non-integral foreign operation, exchange differences arising on the translation of non-monetary asset at the date of reclassification are accumulated in foreign currency translation reserve. So on the date of reclassification, whatever is the foreign currency exchange differences, that is accumulated in FCTR. When a non-integral operation is reclassified as an integral foreign operation, then whatever are the translated amounts for non-monetary items on the date of change are treated as the historical cost. Means NIFO has become IFO, integral foreign operation. So whatever is the translated amount for non-monetary items on the date of change, they will be considered that these are the historical cost. These are the historical cost. Historical cost meaning that is the cost, that is the deemed cost. Let us say $10,000. Actually, if it is integral foreign operation, if this 10,000 is at 80, you will value it at 80, 1, 2, 1, 2, 3. This is how you will value it. Okay, but this is on the date of transaction. However, on reclassification, let us say the rate is 82. Now the costing for you will be 82, 1, 2, 1, 2, 3. This is how you will do. Exchange differences which have been deferred are not recognized as income or expense until the disposal of the operation. So whatever is there in FCTR will continue to remain in FCTR, and when you dispose the non-integral foreign operation, the balance in FCTR will be transferred to your income statement. So the cumulative amount of exchange differences which have been deferred should be recognized as income expenses in the period in which the gain or loss on disposal is recognized. So whenever you dispose of a non-integral foreign operation, you will recognize the gain or loss on the disposal of that foreign operation, and the FCTR balance, foreign currency translation reserve balance, is also transferred to the P&L. Okay. Then small thing about forward exchange contract, don't go into too much of depth of foreign exchange contract. There are 2-3 types of questions which are given in the study material. Only those type of questions, or the past exam papers, only those are tested. So if there is a forward exchange contract, forward means you enter into a contract to buy or sell let us say an asset in future at a predetermined price. Okay, so if it is a non-speculative one, then for example it can be an asset, it can be a dollar, anything it can be. So let us say today USD is 80. We have entered into a forward contract to hedge our receivables or payables at USD 82. Okay, that is what we have hedged. Now this 2 is the premium. This 2 is the premium. If we sell, then it is a loss for us. If you are buying, it's a gain for us. So whatever is the difference between these two, this 2 is called the premium. This premium is amortized over the life of the contract. This premium is amortized over the life of the contract. Okay, whatever are the exchange differences are recognized in P&L. Cancellation are also recognized in P&L. But this premium, so let us say it is a 6-month contract, and you have to pay a premium of 2. Okay, for $1,000. So 2 into 1,000, which is 2,000, which is the premium, divided by 6, 333.33 will be expensed in each month. That is as far as the forward contract is concerned. So any premium or discount arising at inception. So if I'm buying at 82. So there is an extra amount I have to pay. So there is a loss. So this loss of 2 will be recognized in the P&L. If it is speculative, then what you will do is all the gain or loss you will recognize in the P&L. For example, it's a speculative contract. I am not using for hedging purpose. I have entered into a contract at 82. On 31st of March, it has become 83. So this 1, if I am buying, it is a loss. This 1 of loss will be recognized in P&L. Premium discount is also ignored, and you will take it to fair value or mark to market value at the end of each period. Now here, This is slightly an advanced concept. It is unfair that these type of questions are tested at intermediate level. What you can do is there are a couple of questions on forward contracts. I'll just show that to you. Here, this question. So here, forward premium paid by the company is 1.35 for a period of 4 months. So 27,000 divided by 4, every period you will recognize this as a premium expense. Okay. So here you have purchased a plan for $10,000. So then the company has entered into a forward contract. Now because you have purchased a plan, you have to pay, means you have to buy dollars. So you have bought forward. But for buying forward, 47.5 and 48.85, the difference is 1.35. This is the premium you have paid, and hence this is your loss, which will be accounted for over 3 years. Gain or loss we have already seen. Then again here, they purchase fixed assets, same type of concept again. So this is one type of question which is tested frequently in the examination, which you should see. To go into depth of forward and future, it will be a 20-25 hour lecture. So the best way for you to handle this is look at the specific type of questions, solve them, and score marks in the examination. That will be my advice at CA intermediate level. Okay. Now we're left with 2 standards. I thought I'd be able to finish it, but I think I overshot the time, and I don't think I'll be in a position to continue because of my strain on the throat. I have another 2-hour lecture for CA final that I'll be taking at 7:30. So for these two, we'll plan one more day. We'll send a notification and we'll cover that as well. For those of you who want to complete it, these 2 standards are already covered as a part of our earlier revision session. Okay. I hope the session was useful. If you found it useful, do like this video and do share this video with your friends. I tried to cover as much as possible in this limited 3 hours of time, just as a refresher for you. No, so what happens, Manoj, is we are incurring a lot of cost on streaming, so that is not actually working out the free classes. We may take a call sometime in the future, but that is not decided. Right now, as I told you, 4,999 is what we are offering it at. If you feel, you can get 75 days access for all the 4 subjects, and you can make use of that opportunity. Okay, so that is one thing. And I hope the session has been useful. Do share it with your friends. If you have not subscribed to the channel, do subscribe to the channel. I'm not a marketing guy who will start asking you to subscribe and all of that right in the beginning. AMA sessions, we'll plan it logistically. If it is feasible, we'll definitely do that. That is there. Thanks Amit, thanks for the wishes, and ask me anything. You can just put it in the forum and ask the faculty to respond. No, so I'll respond. I know, ask me anything, and all of those are interactive. We'll plan it sometime. Let's see if it can be fixed in September. We don't want to disturb all of you in October, because October all of you should be preparing well for your examination. 2-3 things: complete your syllabus, revise any questions, ask us at the forum. Anything you want to ask, you can make it private. Personal questions also you can ask it at the forum. Solve MCQs, complete your mock test. Mock test will be added in this week to all of you, and you can attempt those mock tests. Okay, chalo, thanks a lot, and see you soon again with some other session. Thank you.